There is not an external pressure catalyst on President Trump right now to pull these tariffs back.
Not only do they cause this uncertainty, but they also raise prices, that you see inflationary impacts from them.
The problem for the president is that a lot of world leaders are not quite sure that they can negotiate with him. They don't want to be embarrassed.
There's still a lot of moving parts to this.
The president's asking the American people for a long leash, and we'll see if the American people give it to him.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday following a wild 24 hours in financial markets, rumors flying that President Trump was considering a pause on tariffs, slapped down by the White House. Levies are set to go into effect shortly after midnight tonight. 20% on Europe, 24% on China, 34% on China, 24% on Japan. The administration doubling down on China. President now threatening an additional 50% import tax on the nation. The Treasury Secretary leaving the door open for everybody else, saying over 50 countries have responded. We look forward to meaningful negotiations with them over the coming weeks. So the question hasn't changed. It remains the same. Is it negotiation or is it a new rule for the game?
And the fact that we are still asking that question, I cannot answer that question because nobody can answer that question. The fact that we are still having that question is really the reason why you saw a $2.5 trillion swing in the S&P 500 in the span of 15 minutes yesterday. What is the lesson from that? The lesson is don't take risk. Don't take risk in stocks and don't take risk in bonds because your face may get ripped off.
The pendulum swinging from one idea to the next. And in between, you can do a lot of damage. And I think we've seen the damage done potentially for the economy in the months to come.
Absolutely. And the pendulum has been swinging. One thing I take of note, though, is yesterday the Treasury Secretary coming out on a network, on Fox News, but also on Twitter, talking about the fact that he is going to be leading negotiations starting with Japan. And that makes you think potentially this is the start of negotiations for a number of trading partners, except for one, China. Overnight, China with some tough words when it comes to the United States, saying that the U.S. threat to escalate tariffs on China is a mistake on top of a mistake, and they will, Jonathan, fight to the end.
Vietnam offered to drop tariffs, rejected. The EU's come out and offered to drop tariffs on industrial goods, rejected. Is it clear what these countries need to provide to this administration?
In a word, no. And I think pretty much everyone across the board doesn't have a clear understanding. And part of that is because there are competing ideals in the White House about what the goal actually is. You have some people talking about the trade deficit, getting it down to zero. You have other people saying, actually, it's just about getting a better deal for the United States to increase production here. In the meantime, markets are reeling, and it's hard to know when stability is going to come back into play.
Equity's doing better so far this morning, at least. Good morning to you all just tuning in. Over the next 60 minutes, we'll catch up with Peter Oppenheimer of Goldman Sachs after a wild 24 hours in markets. John Lieber of Eurasia Group as President Trump plays tariff hardball, and Skylar Montgomery Koning of Barclays on why investors are in max bearish dollar territory. We begin this hour with stocks pushing higher, looking to snap a three-day losing streak as countries rush to the negotiating table. Peter Oppenheimer of Goldman Sachs writing, we would argue that we are in an event-driven bear market triggered by tariffs. However, it could easily morph into a cyclical bear market given growing recession risk. Peter joins us now for more. Peter, welcome to the programme, sir. It's good to see you. What's the difference between the two? Why is that distinction so important this morning?
Well, actually, the distinction is not that much when you look at the typical falls that you tend to get. In both cases, the falls on average in equities are roughly about 30%. There's a reasonable distribution around that. That's the average. But mainly, they're distinguished by how long it takes for the market to fall and then recover. And in what we call event-driven bear markets, that process is a lot faster. What's the difference between the two? Well, event-driven bear markets, as we call them, are something that's sort of triggered by an exogenous shock, an event like tariffs, that really just forces the economy off its previous track. Whereas a cyclical one, the most common type of bear market we see in equities, is really about recessions. So the critical thing from here really is to what extent investors really start to fully price a recession, which would imply profits fall and equity valuations have further to decline.
Peter, I guess we're trying to figure out how much the damage is being done by just simply uncertainty and how much the damage is being done by actual profit margin contraction, by consumers facing off higher prices. Which is the bigger impetus for some sort of recession at this point in your mind?
Well, I think one of the triggers here, as you say, is uncertainty. In the end, uncertainty is the enemy of activity and of risk assets, because what tends to happen is that both investors and companies, as well as consumers, tend to just hold back. Decisions are pulled, and that results in slowing activity. But obviously, as economies slow, then you tend to get other sort of factors that come into play. Now, the good thing, I would say, is that there are some important underlying supports of economic activity. Private sector balance sheets generally are quite strong, both corporates and banks. Of course, there's also room generally for central banks to be cutting interest rates, which will be helpful in time and is usually one of the necessary conditions before equities really recover from a bear phase. But I think at the moment this is really about uncertainty and about investors trying to calibrate how far economies slow and for how long.
Yesterday's price action was interesting to me, Peter, because it highlighted the fragility of the liquidity in the market on all sides. Just this idea that why would anyone have conviction to buy right now when you could be blown out of the water by just simply a headline that is unsourced, that comes out and then gets reversed 15 minutes later? How much is that kind of volatility, if it persists, enough for you to actually lower your forecast yet again for the S&P?
Well, I think the critical issue here, again, comes back to whether there's likely to be a recession or not. Our economists believe that the probability of a recession in the US, for example, over the next 12 months is now around 45%. But indeed, if the full expected tariffs come through and there is no pullback, that would likely trigger a recession. And look, in a recession, typically profits do fall anywhere from sort of 10 to 20% or more, depending on what industries they're in and in what regions. And of course, if investors start to price that as a likely outcome, the most likely outcome, then equity indexes have further to decline as they price in lower profits and probably a lower valuation as well. So, we still have downside in the short run in our targets, but I think also the sort of conditions you're likely to see to really sustain a base in equity markets for a proper recovery are not really yet there, I would say.
Peter, at the beginning of this year, there was this idea that if the U.S. didn't enact tariffs, you would end up seeing the pain more greatly around the world, particularly in Europe, maybe even in China. That has been shifted, although now we seem to be heading back to that kind of idea. Where do you stand on this? Do you think that the U.S. is the epicenter of pain or simply a part of a global trend that is not going to leave really any bright spots?
Yeah, I think it's interesting the point that you raised there. I mean, certainly when we surveyed investors early this year, asking them about what they thought the impact of US policies would be, it was very much a focus on being negative for the rest of the world, particularly Europe and China, as people focused on the impact of tariffs, but would be really quite positive for the US because people had in mind the potential for tax cuts and for deregulation. And while that potential still exists, what's happened, I think, in the US is that the focus has very much shifted towards the impact of tariffs in the US, both in terms of higher inflation and investment and growth uncertainty. So it's really now become a sort of global issue, engulfing the world in this uncertainty and therefore raising the risks of an economic shock that hits profitability and profit margins more broadly.
Peter,
Yep.
Well, we heard from the Treasury Secretary yesterday who talked about how the president gave himself maximum negotiating leverage. And now Bessent with Jameson Graham will be leading these negotiations, starting with Japan. Does that give you some sense of optimism? Can you put this genie back in the bottle?
Well, look, anything is possible. We know that the tariffs are about to be enacted, but of course there is room, I think, for negotiation, and that's the signals that have come out of the administration. But again, negotiations can take a long time and can be quite complex, and that's going to create an environment of uncertainty, at least for a period of time. But also, I think it does demonstrate that we're in a changed sort of global environment in terms of the world trade architecture. And this was already beginning to shift in the months that followed the pandemic, as companies around the world tried to diversify supply chains. So we're in a less globalized environment. That's going to put some downward pressure on world trade, and of course has implications both for inflation and growth. But I think it is, of course, possible that this is part of a tactic to negotiate and come to agreements, but we've got some time yet of uncertainty. Bear in mind also that we came into this year with relatively high valuations in risk assets, both in equities and credit. They were not pricing much downside risk at all. We're still in the process of that adjustment coming through.
Talking about valuations, and that's really where I wanted to end, was this idea of large cap tech stocks that seem to lead the way. And there was sort of a hint that maybe they could lead on the way up yesterday, but some of the damage has been pretty impressive. I mean, Apple, for example, has lost almost $640 billion of market capitalization since the end of the day on April 2nd. That's about 19% of its value. Do you see big cap tech leading again global stocks, given the fact that we are seemingly in a new world order?
Yeah, I think it's an interesting point. When we came into this year, our strategy was very much about diversification, both geographically, given the huge dominance that the US market had sustained up until that point, but also across sectors and factors. And we really emphasized the risk, in a sense, that the US market had become so dominated and concentrated in a small number of super large tech companies. Of course, what we've seen since the beginning of this year, aside from the slowdown in growth expectations, is that some of the big tech stocks have been hit as you see new competition emerge, particularly from China. But to be clear, these companies are very profitable, they have very strong balance sheets, they're very cash generative, and in that sense, pretty defensive. And we've also done some work, comparing the technology ascent that we've seen in recent years to the period of the tech bubble a quarter of a century ago, and there are some major differences, particularly in terms of valuation. These large companies are nowhere near the sort of bubble type valuations that we saw a quarter of a century ago around the internet, or indeed in other bubble periods in history, like Japan in the late 1980s. So I think that the tech sector is still going to be a very important cornerstone of the recovery in equity markets as it comes through. And many of the biggest companies are relatively defensive in terms of their balance sheets, and that's an important factor, I think, to bear in mind.
Hey, Pete, good to get your thoughts this morning. Peter Oppenheimer there of Goldman Sachs. Thank you, sir. If you are just joining us, a bit of stability. Equity futures on the S&P positive by 1.2%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. U.S. small business optimism fell last month by the most since June of 2022. The share of business owners expecting better conditions in the next 6 months fell 16 percentage points. That's the steepest slide since December 2020. NFIB's chief economist said that it's Trump policy leading to the increased uncertainty. Billionaire Ken Griffin says that President Trump's latest tariffs are a, quote, huge policy mistake and a tax on families that will increase costs for everyday items. Griffin, who is a Republican megadonor, urged people to reach out to Trump to reconsider his tariff policy. Now, speaking of Apple, President Trump's threat of new tariffs has caused a surge in Apple Store customers. They're panic buying iPhones due to concerns of price increases. Apple's U.S. retail stores saw higher sales over the weekend. Employees there describe the atmosphere as similar to the busy holiday season. And that's your brief. John.
Hey, Danny, thank you. More from Danny later on in the hour. Up next on the program, tariff confusion.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals.
Up next on the program, John Lieber of Eurasia Group, live from New York City this morning. Good morning. Lisa Shannon at Morgan Stanley saying it was like firing the bazooka into the dark. That's what it's been like over the past few days. Equity futures on the S&P 500 bouncing back positive here by 1% on the S&P. On the Nasdaq up by 0.8. Under surveillance this morning, tariff confusion.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs. They don't want to be in the hands of the Chinese. And the Chinese have turned out to be really not very good at that. People that are with us, they're with us. But we cannot be taken advantage of any longer.
So here's the latest this morning. President Trump offering little clarity on what he is seeking from trading partners in exchange for lower tariffs. The president leaving the door open for talks, but also threatening to impose an additional 50% import tax on China. Bloomberg's Tyler Kendall joins us now for more, alongside Ollie Crook as well. Tyler, first of all, to you. Set to kick in later on tonight. Is there space to negotiate here or not?
Yeah, good morning, John. Really big questions about what this White House is really looking for. And the administration seems to be signaling that it's going to take some time to negotiate as President Trump rules out a blanket pause. Now, I had the chance to catch up with Treasury Secretary Scott Bessent yesterday, and I asked him if we could expect any deals ahead of tomorrow, and he said likely not. However, when I did ask him if the White House was considering lowering that current 10% tariff floor that's in place, he said that everything is on the table. So if everything is on the table, then of course the big question is, what does it really take to clinch a deal? And it's becoming increasingly clear it's going to take more than just lowering tariff barriers. Take yesterday as a prime example. Israeli Prime Minister Benjamin Netanyahu, the first foreign leader to come face to face with President Trump since his tariff announcement, he pledged that Israel was going to not only eliminate tariffs, but also eliminate Israel's trade surplus with the U.S. And when asked if that would be enough, President Trump said maybe not, and that was considered to be the more friendly approach. Of course, you mentioned China there, which in a statement earlier today had some pretty tough words. While saying that they would prefer dialogue to resolve disputes, they did vow to fight to the end as this rhetoric continues to escalate. And John, I would just mention one other important piece of reporting from Bloomberg News yesterday. It appears, according to sources familiar, that there are no established systems in place for companies and countries alike to register their complaints at Commerce, the USTR, or the NEC, which is further raising this confusion.
Oliver, let's bring you in here. Trump said yesterday the offer from European Commission President Ursula von der Leyen was not enough to reset transatlantic relationships. So how are the Europeans approaching Washington now?
Part of the problem is they have no idea what is enough to reset that trading relationship, as you were alluding to. You know, the European trade ministers assembled yesterday in Luxembourg to really get that collective response, the first really to this latest round of tariffs from the Trump administration. They have Plan A and they have Plan B. Plan A is a negotiated outcome for the end of tariffs. This is what basically everybody in Europe would like to see happen. The reality of the situation, though, when you speak to these trade ministers, you say, do you get the impression that the Trump administration is in any mood to talk? The answer is no. Do you have any idea of what the sort of non-monetary barriers specifically you'd like to see, he'd like to see reduced in order to get a deal? The answer is no. That takes us to Plan B. Plan B is a much more full-throated retaliation against the United States that includes not only tariffs, also includes potential taxes on services, taxes or regulations on tech companies, and that is the plan that is being slowly assembled now. That being said, what the European policymakers are doing right now, the word of the day yesterday was de-escalation. They want to create as much runway as possible to have these negotiations with the Trump administration. Next week, we understand we are going to get a measure of retaliatory tariffs. That is just on aluminum and steel. That will be fairly modest, but they're trying to give themselves as much space to communicate with an administration that, frankly, so far seems to have no interest in speaking to them.
Ollie, thank you, sir, for the update. More from Ollie coming up later on today on Bloomberg TV alongside Tyler Kendall. John Lieber of Eurasia Group joins us now for more. John, Vietnam made an offer, rejected. The EU reportedly made an offer, rejected. Do you have a decent idea of what this administration would like to see?
I think they want to see manufacturing coming back to the United States. And so they're not interested in offers. They're not interested in other countries lowering their tariff barriers immediately. What they want is a long-term plan to send a signal to the market that the U.S. is now planning to source from the U.S. And that means they have to commit to this durable tariff regime. And that's a really bad sign for other countries that want to come in and do deals. And it's a really bad sign for global growth and the U.S. economic outlook.
John, how long would that actually take?
years. I mean, I don't think anybody thinks this is going to happen overnight. You've got 80 years of supply chain deepening going on around the globe that the Trump administration is now trying to dismantle piece by piece. Now, we do think there is some room for these tariff barriers to come down. If you remember Trump's campaign, he campaigned on 60% tariffs on China and 10% tariffs on the rest of the world. We're above that currently. And so, there's still a lot of space for these individual tariffs on individual countries to move downward. I do think that 10% floor remains in place. And I think this is going to be a really lengthy process as other countries try to figure out, they're probing here, trying to figure out who they can talk to, what they can offer the U.S. The U.S. is giving them no signals of where relief is going to come from. But eventually, I don't think Donald Trump or his political coalition can handle the kind of political and economic pain that's going to follow from these tariffs. So they are likely to come down at some point, but it's not going to be this month. It may not even be this quarter. So we could be in for a long period of pain here.
Well, for the first country that's going to be able to at least get to the negotiating table, Japan, the Treasury Secretary said yesterday he and Jamieson Greer, ambassador of USTR, will be at the table having that negotiation. Is that a sign to you that if you want to get a deal done, you have to now go through the Treasury Department?
Not necessarily. I mean, I think there's going to be, Scott Bessent's only one man, and he's got a team in there. But there's a lot of countries that have to be negotiated with here, and the USTR has typically taken the lead on that role in these negotiations. I think the Japanese really wanted Bessent to be the lead negotiator. They think it's a sign of their importance in the U.S. trading relationship, and I think there's diplomatic reasons to make the Treasury Secretary the face of that particular negotiation, but I would expect going forward that the USTR has a much bigger role here.
When it comes to China, we had a statement from the Commerce Ministry overnight from Beijing talking about the fact that if the U.S. insists on its own way, China will fight to the end. They're also calling for a dialogue to resolve the disputes. They said this in a statement. At what point do you see Beijing and Washington coming to the table and having this discussion?
I'm not sure. It's really difficult to say right now. I think that you look at the tit for tat escalatory cycle of what's happening here, and I think that there's just not a lot of deal space. I think the Chinese are probably correctly assessing that they can withstand their political, the stability of the regime. Leadership can withstand a lot more disruption than the United States can, given how we have elections here. And Trump's popularity is almost certainly going to go down, and that's going to start to cost him on Capitol Hill. That's going to cost them in the midterms next year, and that's going to cost the Republicans in 2028 when the elections happen. So if I'm the Chinese, I think I've got a lot of ability to withstand this. They've been preparing for tariffs for a long time, and they seem very comfortable to be in a position where they're retaliating against the U.S. in order to weaken, and the end result is weakening the U.S. economy and weakening Trump. And I think that's what's going to happen here. And I think the Chinese have the ability to remain dug in, and that doesn't leave a lot of deal space.
John Lieber, Eurasia Group. John, wonderful to get your perspective on things. As always, Senator Cruz going into the weekend did start to push back against some of this. Has he got company on Capitol Hill?
Well, he's talking about the fact that he thinks that, one, this is going to be potentially damage when it comes to the economic pressures for American families. And then he's thinking about, of course, 2026 and the midterms. And he said that if this damage continues, there will be a bloodbath. Today's going to be very interesting. You want to know about other people that are joining him? Let's see what the questions look like to USTR's Jamieson Greer, who's going to be on Capitol Hill in front of the Senate Finance Committee today, trying to explain the mixed messages we're hearing out of this White House.
And the methodology that was used to put these major tariffs on these countries that are set to kick in overnight.
Which has defied a lot of logic and really raised the question, is it really ultimately the trade deficit and a formula that potentially some places might not be able to complete?
We'll catch up with Stephen Miran, the chair of the Council of Economic Advisors at the White House, a little bit later on this morning, so look out for that. And next on the programme, Skylar Montgomery Koning of Barclays on why investors are in max bearish dollar territory. That conversation up next. So many downgrades to equities over the past few days. Evercore, JP Morgan, Oppenheimer, Bank of America, BlackRock has joined the party. HSBC and Max Kettner. Check this out for a quote. The one thing about that we've been wrestling with ourselves in recent days is whether we're actually bearish enough. I think that speaks to the moment we're in. at the moment. Live from New York City, welcome to the program. Bouncing back a touch on the S&P 500. Off the back of that three-day losing streak, up by 1.3% on the S&P. On the Nasdaq, up by 1 full percentage point. Let's get you some morning movers. We can do that with Danny Berger. Hey, Danny.
Hey, John. Easily the best performing stocks in the pre-market are moving not just because of tariffs, but it is health insurers. CVS among them, up more than 6.5%. After the market closed yesterday, the Trump administration offering bigger payouts via Medicare to the private insurers to the tune of $25 billion. They say it's because higher prices, but that exceeds even the most optimistic scenario laid out by analysts. So Humana, CVS, United Health, all of them rallying. Broadcom also putting out a $10 billion buyback into the market. Those shares up nearly 3%. Remarkable for a company which is a semiconductor company, very exposed to international supply chains, very exposed to Apple. It is a big supplier for them, but the company's saying we are confident. And by the way, after a 15% slide, the stock a whole lot cheaper to buy back. Rounding things up with Levi's this morning, because this is one of the first retailers to provide us with a sense of earnings after Trump announced tariffs. You can see by the rally what they said was interesting, 13% higher, saying that they are keeping their forecast for 2025. A hold on forecast is enough to get this market excited because there's so much expectations for downgrades. The rub, though, this assumes no deterioration in the macroeconomic environment. They said that they don't even know how to incorporate tariffs, and they've assembled a task force to try to do so. John.
Danny, thank you. That's a major assumption. A major assumption. Can you imagine if the rest of the companies this week, the banks come out of that on Friday? Here's our guidance, but we don't assume any change to the macro environment. What kind of guidance is that?
That's not a guidance. And frankly, that would leave a lot of people wondering how clueless they actually are, given the fact that every economist across Wall Street has downgraded their expectations to growth. How could that not affect what consumers are going to end up doing? I would like to see guidance in that task force. Good luck.
On our radar this morning, our top story, China vowing to, quote, fight to the end as President Trump threatens an additional 50% tariff. The blunt reaction from the Chinese Ministry of Commerce suggesting Beijing will resist short-term negotiation.
So you're seeing the tit for tat really take place when it comes to Beijing. What is interesting is Trump with this warning that if China does not withdraw its 34% increase, which comes into effect in 2 days, April 10th, the U.S. comes into effect April 9th. That means, in cumulative, the levy on China for some products will be north of 100%. That is why today I think it's really interesting to hear what the likes of Jamieson Greer, the president, has to say when it comes to Beijing specifically.
The contours of an off-ramp, if we can call it that, was slowly coming together yesterday if the president wants to take it. And of course, it's up to the president, just one man that gets to decide here. If you have a look at what the president said yesterday about doubling down on China, followed up by Secretary Besson out on X, who posted the following: China has chosen to isolate itself. Over 50 countries have responded openly. We look forward to meaningful negotiations with them. And if you go to the FT op-ed that we had from Peter Navarro as well, there's a line in the FT op-ed right at the very end that said, we will want to hear from countries including Cambodia, Mexico and Vietnam that you will stop allowing China to evade US tariffs by transshipping exports through your country. So I got a real sense yesterday, I think we all did, that they were coming together to isolate China, double down on them and open the door to everyone else. That seems to be the off-ramp that's coming together.
Which it really raises the question, what does ultimately a decoupling, a full decoupling, a more concrete decoupling look like between the U.S. and China? Are we actually considering that? Because if there is no off-ramp and you have China doubling down as well, at what point can you maintain some of these international businesses? And that's the reason why I keep watching Apple shares, because that is one stock that is massive, that really depends on the Chinese economy and production in that region.
I'm glad you mentioned Vietnam and Cambodia, because Xi Jinping is headed there in a few days. These are the countries he's going to, and these are the places where Chinese manufacturers had went to try to avoid any retaliation, seeing the writing of the wall of potentially Trump coming back into office. But now those countries are getting hit with tariffs. Why? Because Trump wants to make sure he is sending this message to China and Chinese manufacturers.
I want to be very clear that these are the contours of an off-ramp that might not be taken or built. This is what JP Morgan said. The fate of the equity market is essentially in the hands of one individual who can unilaterally ease or deepen this shock, and I think we all agree with that. The billionaire Ken Griffin calling President Trump's tariffs a, quote, huge policy mistake, saying the levies amount to a huge tax on middle-class consumers. Griffin adding that bringing back US jobs is a, quote, 20-year dream, not something achieved in 20 weeks.
This goes to the question of strategy, execution risk. You might want to bring jobs back, but how do you do that if you've got policies that go on overnight? This is really important because Ken Griffin is a super donor to Republican Congress members, to the Republican presidency. So if he's coming out and being so vocal about this alongside Bill Ackman, alongside a whole host of other business leaders. At what point does that get people's attention?
Lisa, you mentioned Apple, so let's get the latest on Apple as well. Planning to source more iPhones from India to offset the costs of China tariffs. The Wall Street Journal reporting the adjustment is a stopgap as the tech giant tries to negotiate with President Trump for an exemption. I look back to that interview that we did with the Commerce Secretary, Howard Lutnick, before he became the Commerce Secretary. He sat around this table in campaign season and said there will be no exemptions. I wonder how different things might be for Apple this time around.
Well, this time it seems as though they are more exposed than they have been previously, especially because of what we were talking about between the escalating tit for tat between the U.S. and China. They are doubly exposed. Their sales in China as well as their manufacturing in China. And there is a meme going around of people on Wall Street sitting next to each other working on iPhones. And it's sort of this comedy. But at the same time, you put these two together. How long does it take to move some of these production change and how expensive is it? Apple's trying to start to get ahead of that on some capacity.
Well, if they don't move production, the only people affording iPhones are the people working on Wall Street anyway, because they'll be about $3,500, right?
That's pretty much where we're heading. And that's the reason why people say it's going to take $20 billion to move just 10% of the supply chain over to the U.S., and it would take 10 years to build that out. So for Apple, it's a pretty big cost, and it's coming at a time where they don't have the time to execute.
I imagine it's that $3,000, $3,500 iPhone that potentially could be the future, that Tim Cook goes to the White House and says, look, do you want Americans paying for this? They're not going to pay for this, and it's going to be backlash on you politically. I imagine that's one of the chips he's going to use. But Howard Lutnick said no carve-outs, no exemptions.
Finally engineered the upgrade cycle over at Apple, though, didn't we? Apparently the stores are packed. Stockpiling iPhones.
Well, I'm stockpiling wine and olive oil.
Getting ready to sell them on the black market.
Well, all I can say is maybe our kids should be on their phones less. Maybe we should all. Okay, I'm going to stop there. But I'm just wondering, at what point do people just get used to a little rough, a little around the edges?
Are the kids tuning in today? Was that directed at them?
It's okay. Just put your phone down. Read a book.
Apple's up by 1.4%. Let's turn to foreign exchange. The US dollar under pressure ahead of President Trump's tariff rollout. Skylar Montgomery, Koning of Barclays, writing, dollar negativity is now consensus and our sentiment index is in maximum bearish territory. Historically, this has been a fairly reliable reversal sign. Skylar joins us now for more. Skylar, historically, I just wonder how different this time might be.
Yeah, I mean, it's interesting because I think the reaction to tariffs was unexpected for the dollar. All else equal, we know that U.S. tariffs should boost the dollar. But I do think there's a logical explanation here in that, our import substitution model shows that dollar strength does occur on U.S. tariffs, but it also shows dollar weakness if all tariff countries respond in kind. Because in that situation, a larger share of U.S. exports would be tariffed than, say, Europe, which only has new tariffs on exports to the U.S. So this tells us that within FX, we're reliant on how the economies respond to U.S. tariffs. The second point has to do with growth and confidence. I think there's this growing concern over U.S. policy. From an economic perspective, tariffs are not wrong if there's an existing distortion. But sweeping tariffs with very little nuance are clearly suboptimal, and they raise recession odds. U.S. growth was already slowing with confidence under pressure. And the one clear conclusion from tariffs is that they are U.S. growth negative, whether they stay in place across the board or renegotiated in some places or not. On the other side, that means if there is also likely still some hope that there are deals and we don't know where those deals would be yet. So I think that reflects some of why you have this dollar downside. But I think it's very hard to maintain an environment of slowing global growth.
Skylar, one thing we've discussed on this program repeatedly is not just the shock to the cycle, but the potential shock to the system. We'll catch up with Stephen Miran later, the chair of the Council of Economic Advisors at the White House, in about an hour from now. And one thing he said, particularly in the last 24 hours, is that the security umbrella that the United States has offered the world, together with reserve assets that facilitate trade, he's making the point that that's distorted the US dollar. There seems to be a pushback against the system. And is that something that we can fully internalize now? I don't think so. But in coming weeks and months, coming years, how are you thinking about those changes?
Yeah, I think because we have these great worries over U.S. policy, they have brought into question the role of the U.S. and it's brought into question the role of the dollar in the global system. In this market narrative around a broad reallocation away from U.S. assets, and that in turn putting pressure on the dollar, we think it's too early to make that call. At a minimum, I think for money to move to foreign markets, you need some kind of improved asset returns in these markets, which seems like a very high bar with global growth slowing. So, for example, in China, margins are mid to high single digits. tariffs on the scale the U.S. is imposing pretty much completely wipe that out, even if you pass a significant portion of that onto the consumer. For bonds, U.S. yields are still relatively attractive, while there still isn't a large liquid alternative market. This is also not the first time that the market has falsely gotten excited about this narrative and it wasn't sustainable. We've had more than a decade of policy that's very much favored the U.S. and it's very hard to undo that. So I'll maybe just finish off by saying that, even if it is the start of a massive rotation, that's something that will take a decade or more to play out. So there's still time to position for it, and you don't need to take on the early signal in case it's false.
How do you get ahead of the idea that maybe China will allow the renminbi to weaken disproportionately to offset some of the damage that we're seeing or potentially increase their export power?
Yeah, I think that's kind of our base case in terms of China. One of the places that rhetoric on trade has been very clear. Tariffs have gone into place. They're very large in scale, and they've only escalated since Trump has been in office. Authorities in China have been artificially supporting the currency, so current tariff rates imply that $CNY should be much, much higher than current levels. And there is this view that they won't let the currency go because they're worried about capital flight. But capital flight will also leave if the growth outlook deteriorates significantly, even if you keep the currency steady. So when the economy deteriorates, they can either take the hit, moderate it via significant subsidies, or they can let the currency go. And they've been unwilling to do large-scale stimulus or enough, at least, to really prompt the consumer to spend again. So we think it's more likely that they do let the currency go, and in part to support their export market. And so we do like being long $CNY, and our target on that is around 750.
Skylar, there's this question about how Europe will respond, and we were talking about the haven status of the U.S. and just how fundamental it is to the overall system. In Europe, they are planning to do fiscal stimulus. There could potentially be other offsets, regardless of whether there's a deal struck. How do you calculate the fiscal impulse into at what point the euro could potentially strengthen in a more material way?
Yeah, so I think the euro in the last week or so, it's benefited from the fact that it's a liquid alternative to the dollar. It's more trading off of U.S. center negativity more than it's trading off of Europe's positives. And now there's this tug of war between tariffs and the fiscal response. And by that, I mean, we do expect U.S. tariffs to put the European economy into recession. That's definitely no. But we've already seen large-scale quantify that as you can look at fiscal, and around 1% of GDP in fiscal expansion is around 30 to 35 basis points. On the long end, you can then take the beta between yields and effects to find what kind of policy response feeds into Eurodollar. So for us, we're very much waiting on what the size of that stimulus is to have an idea of where we think Eurodollar fair value is. But you also need to consider there are other components, right? If CNY weakens materially, that will also put downward pressure on euro. So you need quite a big fiscal stimulus, I think, to offset the tariffs that we've seen, with one measure saying that, the fiscal that we got from Germany already adds around 40 basis points to European growth, but a 5% tariff takes away 40 basis points, and we're at 20%.
Hey, Skylar, we've got to leave it there. Appreciate your time. Skylar Montgomery, Koning there of Barclays. Thank you. So if your equity market's getting hammered at the moment, you have one or two choices. You can negotiate or you can intervene. Taiwan Stabilisation Fund deciding to support the stock market. That headline just crossed in the Bloomberg. Intervention's one option. Negotiating's another. Japan coming to the table, and look at what happened to the Nikkei 225 overnight, up by 6 percentage points at the close in Japan this morning.
There was some conciliatory language coming from both Scott Bessent saying that he had productive conversations with the Japanese, as well as President Trump, who said that he did feel good about his conversation with the prime minister there. It does raise the question, and it goes back to which countries is this administration willing to negotiate with? It seems like Japan, sure. Mexico, Canada, we're getting to somewhere. Europe, where does Europe get left in all of this, given some of the harsh rhetoric and the personal aspect of cars and meat and cheese that seems to be coming out of the White House?
A rock and a hard place at the moment between China and the United States. Equity futures up by 1.6% on the S&P. On an update on stories elsewhere, with an update, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China is urging fast fashion retailer Shein not to move its production out of the country. People familiar telling Bloomberg that the Chinese Ministry of Commerce has discouraged Shein and other companies from moving their manufacturing to other countries in reaction to President Trump's tariffs. BlackRock CEO Larry Fink said most CEOs that he talks to think that the U.S. is already in a recession. Fink warned that stocks could keep falling as President Donald Trump's tariff policies destabilize the world economy. Speaking at the Economic Club of New York, Fink said in the long run, this is more of a buying opportunity than it is a selling opportunity. New York City's congestion pricing program is likely to remain in place for the next several months. The MTA and the Trump administration have agreed to a timeline that would keep congestion pricing tolls on through late October as both parties await a ruling, according to court documents. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, repricing the Fed put.
If we have something that's both deteriorating economic growth and driving up the prices, that is to say, something that is stagflationary, there's not a generic answer to what the Fed should do in response to that.
The Federal Reserve is not racing to step in. Up next on the program, reaction from Earl Davis of BMO. Live from New York, you're watching Bloomberg TV. The world is truly upside down. Communist China. Out on X yesterday, the Chinese embassy posting a video of Ronald Reagan arguing against tariffs back in the late 80s. Can you get your hands around that? Get your head around it?
At this point, the trade system as it is benefits China. They would like to preserve it. And there are a lot of people in the U.S. who also would like to preserve it because their businesses run on it. So there you go.
They want the walls up at home and they want the walls down everywhere else.
You know,
That's how this works.
This is going to be the crux of the reason why this is so difficult to negotiate.
And this is why they're going to try to take advantage of America's closest allies like the European Union in this time to try to forge closer relationships because they need a market to dump on as well and continue to dump on. And the European Union at some point is also going to say, we need fresh markets as well. If we can't go to the United States, we're going to have to keep going into Beijing.
Oh, the hypocrisy. Equity futures right now in the S&P positive by 1.4%, bouncing back by 1.2% on the Nasdaq. What happened in the bond market yesterday? Why were yields up so much, even with risk down through most of the session? We'll talk about that in just a moment. Yields are lower this morning. We're down by 2 basis points on a 10-year, 4.1567. Under surveillance this morning, repricing the Fed put.
Our job is to look at the hard data, and if we have something that's both deteriorating economic growth and driving up the prices, that is to say, something that is stagflationary, there's not a generic answer to what the Fed should do in response to that. Depends how much it drives up prices, how long it's going to last, and how much it reduces growth.
So here's the latest this morning. Fed officials not rushing in to support the market, facing down downside risk to growth and upside risk to inflation. Earl Davis of BMO writing the Fed will ease by 50 basis points at or before the next FOMC meeting. Earl joins us now for more. Earl, that one's punchy. And some people agree with you. Bob Michael of JP Morgan made a similar point on Sunday evening. What gives you the confidence, given what we've heard from Fed officials, that they'll do something different to what they're saying?
Yeah, no, we do believe that growth and inflation are the major discussion points at the Fed, and you're hearing them discuss both and debating both. We add one more point to their decision matrix, and that's, the sentiment of the populace. And the reason why we put that in, like, the U.S. is a consumer economy. You don't get spending unless you have certainty. If we're not going to get certainty on the policy or in regards to the retaliatory response from other countries, or the fiscal side, you get it from the monetary policy side. So we think the combination of growth, which it will definitely be lower, plus consumer sentiment getting more fearful and lower, is the thing that turns the Fed towards easing. The 50 basis points of easing, the reason why we feel that is that, it was heading into Liberation Day. We thought that last week would be the week of peak uncertainty. It was not. So because of that, we haven't hit peak uncertainty yet. We believe that if and when the Fed goes, they will go by 50.
Earl, is there a warning shot sent by, frankly, what we saw in the market yesterday with 30-year yields widening out, rising at the fastest pace going back to the pandemic, that if the Fed does move, that maybe the reaction in markets won't be what they're looking for?
I think you can look at it that way. I don't look at it that way as an active manager. The reason why I don't look at it that way is that you have to always understand who's your marginal buyer or seller in the market. They are the ones that set the price. So I'm not a believer that the price or yield that you see is a reflection of market expectations. It's a reflection of that marginal buyer or seller. Now, going to yesterday, the next question you have to ask is understanding who the marginal buyers and sellers are. Yesterday was what you call an uneconomic seller. They don't care about prices. They don't care about losses. There's two types of uneconomic sellers. One is the deleveraging seller. Someone who has a lot of leverage in the market, gets a tap, is no longer on the desk, so the shop closes the book, and they just sell to get out of the position. The other one is, as you've heard, the possibility of foreign selling. To be determined which one. Right now, my default is that it was the first, not foreign selling, but the first. So what's the difference between the two? If it's like a hedge fund manager or something, positions being closed, the persistence of that's very short, which says you could have a quick snapback here. If it's foreign selling, you would see continued, and we could go towards 450 if it is. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning. It is one of their roles. So for that reason, we believe in US 10s at 420 to 450 is a buying level. We see the longer term range from 450 to 350.
This is really a huge bet on the Fed and on the Fed put. At what point do you think this is different, especially that maybe this Fed has learned a lesson from the previous times that it either hasn't hiked rates or hasn't cut rates, but really has underestimated inflation consistently?
Yeah, the challenge the Fed has, it's almost like a triage. You got to deal with what's the most deathly symptom at the time. Not to say that the longer term impact of doing that will be beneficial. So there is a risk. So when do bonds really sell off? I believe if the Fed does 50 and does not introduce QE again, you have the real possibility of 10 years and 30 years selling off because of risks of inflation. If they do QE, I think it maintains it for a while. And I think the objective of doing this, cutting 50, doing QE, is to move money off the sidelines, $7 trillion plus in money markets. Move it off the sidelines, move it back into investment and growth. And you saw that through QE, through driving real yields into the negatives. I think that will be the game plan from a medium-term perspective to get growth going. Then they don't have to ease as much following that. But it is weary, and it's not easy. So I'm not saying, but just given my history, like I said, I've been 30 years an active manager in the market. This is the dynamic and the mechanisms I've seen in the past, and this is what my expectation is right now.
Oh, appreciate your opinion on it. Thank you, sir. Earl Davis there of BMO on the bond market. Those moves got the attention of all of us, and I'm sure for all of you as well, sitting at home watching it. We've been talking about it for a while on this programme. What would happen if equities, risk, gapped lower, but bond yields started to climb? Does it speak to foreign selling? There's one reason alone why I think you can take some comfort that wasn't happening yesterday.
The dollar.
The US dollar. Did not see that accompanying dollar weakness that you might expect if that was the case.
And that's the reason why people said maybe this is just margin calls, maybe this is just banks for de-risking.
We're going to see, but it's certainly one to keep on your radar, that's for sure. Up next on the programme, Julian Emanuel of Evercore, Alex Nowrasteh of the Cato Institute, Daan Struyven of Goldman Sachs, and Stephen Miran, the chair of the White House Council of Economic Advisors.
When you look at these moves, we describe it as a bang and a whimper. We're in the bang phase of this drawdown.
We went from stagflation in terms of people's thinking to recession in about 2 seconds.
I do think it's going to be hard to avoid, further moves down in the market.
Retaliation may not be just as it relates to tariffs. It may actually be as it relates to investment in U.S. assets.
We're taking a tremendous amount of near-term painful medicine.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P. Near session highs up by 1.5% on the S&P 500. Following a 3-day losing streak, we're higher by 1.3% on the Nasdaq 100. Later on tonight, 1 minute past midnight, 20% tariffs on Europe, 24 on Japan, 34 on China, plus an additional 50 if the president is right and China retaliates, and they're going to go forward with their own 50%. So that's what you confront going into the overnight session over in Asia a little bit later. Equities elevated. That's your day ahead. That's basically it. Is there space to negotiate here, or are these the rules of the game? And the pendulum just swings between one option to the next from day to day. And yesterday there was this belief that maybe there was a door opening to negotiate.
And it's partly because of the rhetoric. It's partly because of headlines, justified or not. But there has been a shift in tone. And that, I think, is what a lot of people are keying in on. Scott Bessent talking about how that there are negotiations and there are things beyond tariffs. You've got Peter Navarro saying absolutely not. Mixed messages seems to be the course. But there is, on the margins, just a bit of a tone shift.
So we reflected on a conversation that Annmarie had with the Treasury Secretary on April 2nd when these tariffs were first announced. And we sat here around the table and we said, we felt like Secretary Bessent just wasn't in the room. He sounded frustrated in the conversation. And now we're hearing reports in the last 24 hours from Politico that Secretary Bessent is back in the room and his strategy is to get the president to suggest he's open to negotiations.
What I take from all of this is that following that announcement, the vision the Treasury Secretary had was shut down. And the real tariff hawks like Peter Navarro and the Commerce Secretary Howard Lutnick won out, at least from the beginning. Potentially, the president doesn't like what he's seeing, and now the Treasury Secretary is going to have a hand in this, and he is going to lead his vision, which is start from a maximalist position, but negotiate towards lower tariff rates. And something interesting, on the way down to Palm Beach this weekend, we were gathering with the president, who was standing behind him, Howard Lutnick. On the way back from Palm Beach to Washington, D.C., who was standing behind the president? Scott Bessent.
A subtle shift, Lisa, in the last few days. Look, this can shift back. I want to keep going back to this quote from JP Morgan. The fate of the equity market is essentially in the hands of one individual who can unilaterally ease or deepen this shock. It's in the hands of the president.
Do we really think we're going to get some kind of resolution by midnight tonight? Part of the problem is that if you have, and you're shaking your head, Annmarie, I think a lot of people would agree with you. The answer is no. And really the issue is, how do you plan a business strategy? How do you plan an investment? Especially at a time where you do see whipsaws of $2.5 trillion in 15 minutes. It becomes very difficult if you're managing money for somebody else to have any kind of conviction with any kind of strategy if it moves on a headline that might or might not be justified.
Fake rumors and wild swings. What a start to the week. Equity futures on the S&P 500 up by 1.5% this morning. Coming up this hour, we'll catch up with Julian, Emanuel of Evercore as investors brace for sweeping tariffs to kick in. Daan Struyven of Goldman Sachs on a second cut to their all forecast in less than a week. And later, the chair of the White House Council of Economic Advisors, Stephen Miran, joins us later. Looking forward to that conversation. We begin this hour with stocks pushing higher as markets look for signs of policy clarity. Julian Emanuel of Evercore cutting his year-end price target on the S&P to 5,600 from 68, writing the following. Prolonged uncertainty has raised asset volatility, damaged confidence and increased the odds soft data eventually infects the hard, causing stagflation or outright recession. Julian joins us now for more. Julian, good morning.
Good morning.
Why are you so bullish? Even with the price target cut, based on what we've seen over the last few days, where does the bullishness come from?
The bullishness comes from an expectation that if we look at the last couple of weeks, we have arrived at the point of maximum uncertainty, okay? And it's like, whether you think about it in terms of market volatility, uncertainty measures, frankly, tariff rates, which is the crux of where the uncertainty is from, all these things really aren't sustainable in the long term, because what ends up happening is you get the recession scenario. And I think as an investor, you have to believe a couple of things here. You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession, because frankly, precipitating a recession has a lot of other knock-on unintended consequences.
None of us can get into the minds of the president. I've got no idea what he's thinking this morning, going ahead to the tariffs that will kick in overnight. Can we touch on valuations? What's the forward multiple on the S&P right now?
It's well over 20 still.
Does that speak to maximum uncertainty?
It does not, okay, but we have maintained this for 2 years now, and it's certainly worked reasonably well over the last 2 years, is that valuation alone doesn't end a market cycle, okay? What ends a market cycle is an oncoming recession, an uncooperative Fed, or bond yields moving higher. And if we think about the last couple of weeks, look, there have been two significant wins here. Number one, oil prices are a lot lower than I think any one of us would have expected,
Agreed.
given the fact that Russia and Ukraine is still in escalation mode, and the Middle East is still in escalation mode for the most part. And bond yields have
you went
also
through
come
three
in.
things, and I was just thinking, tick, tick, tick. Fed's showing no willingness to step in. Yesterday, bond yields were higher. What's the circuit breaker for?
So you have to differentiate between a Fed willingness to step in and a Fed who's going to say inflation, which now, in our view, is in the mid-threes for 2025. I don't think he's going to remove the word transitory because, and our research shows that essentially the real threat is less inflation. It's the one-time hit from wherever we go, and our operating view is that tariffs will actually settle in around 15 to 16% on a global weighted basis, call it by the end of the third quarter. That's how investors can live with it going forward, but that the real threat is the new tariff regime slowing growth perhaps even more.
Is it overly complacent to view this as just business as usual? To not really consider a structural change that, frankly, is the goal of this administration that could potentially reorder trade and potentially cause a decoupling between the U.S. and China?
Well, again, in 80 days, you're trying to remake a global trading system that took 80 years to build. So to call it business as usual, would be someone who perhaps didn't take defensive measures to his or her portfolio in the last number of weeks. And the question is, are we going to get, and I think Secretary Bessent was right and proper in making the point that there needs to be more singing from the same hymn sheet and an openness to cut deals.
One of the big concerns yesterday was what happened in the bond market. And we were talking about it. A lot of people called me. They said, what are you hearing about this? People didn't have an understanding, but it spooked people. You saw the biggest sell-off in 30-year bonds going back to the pandemic. And why? I don't know. Maybe because of disruption, maybe because of basis trades, maybe because of foreign selling. At what point does that type of disruption fundamentally spook you? And frankly, your bullish call for gains by the end of the year?
Well, actually, at this level of yields, perfectly reasonable. Now, again, remember, part of what we're saying is that asset price volatility all over the place is much larger. So if we're ranging between 390 and 430 or 440 or so in the 10-year yield, that's okay. We live with the volatility, but on balance, that is a rate for forward discounting of share price multiples that we can live with. It's the question is, what was behind yesterday's selling? We don't buy into the fact that it was international investors dumping bonds. We buy into the fact that logically, if you think about it, given the moves that we've had in the last several weeks, it's asset allocation.
But to me, the idea that one headline could drive $2.5 trillion of value destruction and creation over, again, just a blip, that's emerging market-like trading. That is not the deepest, most liquid market in the country, in the world. That is not what we're used to. And that is not the reason why people go to the United States on a risk-adjusted basis that completely undermines the whole premise of the U.S. market. Why does that not shake your confidence that there can be the same kind of dynamic going forward of some sort of American market exceptionalism?
No, you're absolutely right about that, Lisa. And that drives home the point that we have to have, I wouldn't necessarily call it off-ramps, but we have to understand what the path forward could look like to be able to deal with and make assumptions and make capital allocation decisions, whether you're an investor or a corporate. And that's why the emerging policy has to have a direction of travel to where we've maxed out on uncertainty, we've maxed out on potential tariffs, and we are going to get in the art of the deal mode. That's why, again, given this incredible volatility that we've seen in asset markets, which does undermine confidence, the month of April is as important as it is to sort of subdue the feeling in markets. And to the good, we would say, if you look at it, the bearish sentiment is as intense as I've ever seen it going back to the financial crisis in 2008. You look at the share volumes the last 2 days, off the charts record share volumes. That tends to happen closer to trend changes than trend continuations. So, it's almost getting to a point where it's so negative that at least there's a ray of sunlight.
You offered up a timeline. The end of the third quarter, you think tariff rates could come down anywhere between 10 to 16%. So basically for back to school. What about all the damage that could be done between different administration officials singing from different hymn sheets between now and the end of September?
Well, that's the critical issue. And again, that's why I think, Treasury Secretary Bessent is trying to get people to sort of come together on this. And to the extent that it does or it doesn't, it really will be reflected in asset prices. But, the shock that we've had to the system over the last month, and in particular the last week and a half, is such that you're in the zone where the sentiment data could materially infect the hard data. And to your point, in home selling season, which we're in the peak of right now, and then back to school, et cetera, that's where the economic risk lies.
Larry Fink told Eric Shatsky yesterday at the Economic Club in New York that the CEOs that he speaks to think we're already in a recession. I just wonder what we hear from the CEOs on Wall Street on Friday when the earnings come out. What do you think they're going to tell us?
I would think that Jamie Dimon will warn the way he has about policy implementation and uncertainty. And look, this is going to be an earnings season where, it's sort of similar to the unemployment report on Friday. It doesn't matter what the numbers are. It absolutely doesn't matter. What matters is the level of expressed uncertainty, and, will companies pull their guidance? And I'm sure there are a few that will.
Yeah. Julian, it's good to see you. Thank you, sir. Thanks for dropping by. Julian Emanuel there of Evercore. It's so bad it might be good. Seems to be the argument. I'm joking. Seems to be the argument from some.
Well, from some, there is this idea that who would want to do this to the system, so they'll have to have an off-ramp. If they don't, I guess that's the real question. What if they don't, and how prepared is the market?
Yeah, it's so bad that people don't think they'll go through with it.
Right.
Yet here we are with additional tariffs over the weekend, a baseline tariff of 10% on overnight. We're going to have additional tariffs, 20 on Europe, 24 on Japan, 34 on China, and maybe even another 50.
Maybe another 50, which means cumulatively we're looking at, for some products, more than 100% tariffs when it comes to Chinese imports. I go back to what Kellyanne Shaw told me yesterday in Washington, and she was part of the trade negotiations and Trump won. She said, you need that uncertainty. That ambiguity is on purpose, because that is how Trump is going to extract maximum concessions at the negotiating table.
Well, we've certainly got a lot of that right now. Equity futures on the S&P bouncing back by 1.3% with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Supreme Court has allowed President Trump to resume deporting alleged Venezuelan gang members under the Alien Enemies Act. The court granted the emergency request in a 5-4 vote. The court ruled that detainees must have notice and a chance to make their case to a judge before deportation. House Freedom Caucus Chairman Andy Harris says that he is open to the creation of a new 40% tax bracket for those earning $1 million or more. Republicans have long opposed any form of a tax increase, but the Freedom Caucus has the power to block a thin Republican majority in the House as it tries to pass new tax cuts amid fiscal constraints. Chinese auto giant BYD said its first quarter profit could more than double after a bumper start to the year that saw vehicle sales top 1 million. The company said total sales through March are 60% higher than a year ago, and its overseas expansion achieved leapfrog growth in the quarter. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny later on this hour. Up next on the program, open to negotiations.
For countries that don't retaliate, we are at a maximum tariff level, and it is my hope that through good negotiations, all we will do is see levels come down.
Up next on the program, the reaction from the Cato Institute. We'll catch up with Alex Nowrasteh from New York City this morning. Good morning. The worst three-day slide since the pandemic and attempted to snap it this morning, up by 1.6% on the S&P, on the Nasdaq 100 up by 1.4%, on the Russell up by 2%. Under surveillance this morning, open to negotiations.
For countries that don't retaliate, we are at a maximum tariff level, and it is my hope that through good negotiations, all we will do is see levels come down. But that's going to depend on the other countries. And President Trump is going to be personally involved in these negotiations. And he believes, as many of us do, that there's been an unfair playing field. So the negotiations are going to be tough.
So here's the latest this morning. The Treasury Secretary Scott Bessent saying everything is on the negotiating table when it comes to tariffs. Bessent saying deals will likely not be done before additional tariffs kick in at 12:01 a.m. tomorrow morning. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. Secretary Bessent's talking up negotiations. How realistic is it that we can negotiate these tariffs away?
Yeah, hey, John. Well, at this moment, it appears that countries are bracing for those current tariffs as planned to go into effect tomorrow, even as the secretary says that he is open to negotiations. But at the moment, it appears that they are going to move ahead at that maximum tariff rate that he mentioned for countries that don't retaliate. Now, I did ask him yesterday which countries he was optimistic about striking a deal with, and he said he was with all of them. Whether or not all of them actually get a deal, though, of course, hinges on the fact that there is still very little clarity on exactly what this administration needs to see done. It is becoming increasingly clear, though, that it will likely take more than just lowering tariff barriers, and in some cases more than eliminating or lowering a country's trade surplus with the U.S., especially as we have some senior administration officials, including Peter Navarro yesterday, penning an op-ed saying that this is not a negotiation, as he doubles down on the idea that any exemptions or carve-outs could potentially undermine investment when it comes to reshoring manufacturing in the U.S., something that, of course, we know is a priority. Now, with that said, we have learned that it appears Japan will get priority in trade talks moving forward. The Treasury Secretary, in an interview just minutes ago, said that potentially an Alaska energy deal could be on the table here, just adding to the additional things that we could see rolled into these broader conversations when we were talking about the tariffs. John, yesterday, White House officials said that about 70 countries have reached out to negotiate so far. One clear trend is appearing, though. It seems that President Trump wants these negotiations to happen in person. He keeps talking about how delegations are coming down to Washington.
Hey, Tyler, appreciate the update. Tyler Kendall down in Washington, D.C., in the nation's capital. To extend the conversation now, Alex Nowrasteh of the Cato Institute. Alex, welcome to the programme. Stephen Miran's going to catch up with us a little bit later, the chair of the Council of Economic Advisors over at the White House. He delivered an address yesterday, and reading the transcript, some amazing things jump out, and I'm sure you had a look at it as well. He talked about the security umbrella that America provides to the rest of the world. And one thing he wrote about what forms countries can take in sharing the burden is that other countries can accept tariffs on their exports to the United States without retaliation, providing revenue to the US Treasury to finance this public goods provision. What is this new era that you think we might be moving into?
Well, I think we're moving into an era of protectionism and high tariffs going forward, and with multiple different justifications. I mean, we've just heard over the last few minutes on this program multiple different justifications for these tariffs from different members of the administration. It's to subsidize American defense expenditures. It's to reshore manufacturing. It's to raise revenue. It's to get some kind of magical leverage over other countries. And a lot of these are competing in mutually contradictory, self-defeating proposals. I mean, what I think is at the core of this, and has been at the core of Donald Trump's way of viewing the world for a very long time, is he just doesn't like trade. That's just the basis for all of this. So I think we're really having a lot of wishful thinking if we think he's going to reverse himself on a lot of these tariffs. I mean, all of these are justifications to keep going on tariffs and to keep raising these rates and to maybe make a small concession here or there. But we're going to higher tariff territory, and it's going to last for a while.
Alex, does he not like trade? He doesn't like trade deficits.
Well, I don't think he likes trade in general. I think he sees economic exchanges with foreigners as zero sum. So if somebody wins, somebody loses. So you're right. If they were all trade surpluses, then he'd probably like that. But as we know from looking at economics, right, these are just not super meaningful numbers. I mean, you and I have trade deficits with our local grocery stores, but we'd certainly be better off buying from them than growing our own food, right?
When it comes to, you say, the tariff rates coming down, staying higher, but Scott Bessent saying that's a cap. we can maybe work towards a lower ceiling of that cap. How high do you think they will stay intact?
So that's a huge question. That's an important question. I think we're going to see a lot of fluctuation over the next several months. Some countries it's going to come down a little bit, others it's going to come up. But I would be surprised if the average weighted tariff rate goes below 20%. We're at about 25, 26%, depending how you measure right now. We could be over 100% with China in the very near future if some of these retaliatory threats come to bear. But we're not going to go back to a situation prior, 60 or 70 or 80 days ago. We're not going to go back to that situation, I think, for quite a while.
What's Congress's role in all of this, Alex?
Well, unfortunately, Congress has given all of tariff responsibility essentially to the President of the United States through various laws. The one being used a lot recently is the IEEPA law, the Emergency Economic Powers Act. Congress has basically abdicated its responsibility. Now, under the Constitution, the Congress does have plenary power over trade policy. It could take that back. Unfortunately, since it gave this power to the president, it would have to pass a law and do it with supermajorities to override any presidential veto. So unfortunately, Congress has sidelined itself, and it will be very, very difficult for it to bring that kind of power back. They should try. It's important for economic policy in the United States and security and good sound policy going forward. But the chance of them succeeding is pretty minimal given how they have to overcome a veto to get it.
Alex, what do we do between now and, say, the next month? Do you see freight just being paused? Do you see things freezing up as people just wait to see what the rules of the game might be?
I think that a lot of people are going to hold back because of the uncertainty of the situation, right? I mean, we saw an insane market swing yesterday in the course of a few minutes that was based on a blip and a verbal pause by Kevin Hassett on television. I mean, people are looking for any kind of good sign that these tariffs are going to go away. They're not going to go away. We're going to see some fluctuations. We're going to see some variations in these rates in the next few months, but generally they're going to remain about as high as they are now on average, and I would suspect that they will stay that way for years.
Alex, appreciate your time. Alex Nowrasteh at the Cato Institute. If they stay that way for years, imagine what things will look like 12 months from now.
It seems like some of these estimates for the S&P will need to come down, because right now there is a faith that cooler heads will prevail. There is a faith that if this is really that potentially economically damaging, they won't go through with this. And what every policy advisor has said to us is they will. So here we are.
You've got to look at it across industry to industry. Some industries will be okay. We have the domestic capacity. Places where we don't have domestic capacity, we will obviously really struggle. There will be some industries that can ramp up that capacity quickly, others where we can't. And this is going to play out industry by industry in the coming years. Ultimately, they want to engineer a supply-side response. The key mechanism for that supply-side response in the meantime is price.
At this point, you can't build a factory in 2 days. So how else are you going to deal with the fact that demand could potentially be coming up at the same time that supply is coming down?
Up next on the programme, Daan Struyven of Goldman Sachs warning that oil could drop below $40 a barrel. From New York, this is Bloomberg. Equity futures on the S&P 500 positive hit by 1.7%. On the Nasdaq 100, a lift as well. Bouncing back from a 3-day losing streak on the Nasdaq, we're higher by 1.5%. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. Who said M&A was dead? Not only do we have a little bit of it this morning, it's also cross-border M&A. Not only is it cross-border M&A, it is a European company buying a bit of the U.S. That is Infineon, the German tech company, buying from Marvell Technology their automotive networking business. It's something really crucial for self-driving cars. The price tag on that, $2.5 billion. Analysts are marking that it is an expensive price tag and that it makes sense for Marvell so they can focus in on AI. Those shares up 4.25% this morning. Also some earnings to get through. Walgreens Boots reporting this morning. beating on expectations thanks to cost cuts, thanks to improved healthcare business for them. Those shares up 2.7%. But remember, this is getting a take private in the form of Sycamore Partners for $10 billion. That deal expected to close at the end of this year. So how much this can rally is a little bit capped, because how much further will it really go from that purchase price? Finally, rounding things up with Stellantis. Most automakers are moving higher this morning. Stellantis standing out for declining 4%. Not only are they trying to navigate these tariffs because they are so exposed to Europe, they've hired McKinsey looking at selling off Maserati and Alfa Romeo. Also this morning, reports that Italian production has fallen to the lowest in nearly 7 decades. The unions there saying it's not going to get better because not only is it falling demand, it's also the impact from tariffs. John.
Hey, Danny, thank you. Appreciate the update. That company's got much bigger problems than just tariffs, and have done for quite a while. On our radar this morning, President Trump rejecting a last-ditch offer from the EU to drop tariffs on all bilateral trade in industrial goods. Ahead of Wednesday's deadline, Trump saying the offer is not enough to reset the transatlantic trade relationship. Elsewhere, Japan is poised to get priority from the US in tariff negotiations after a productive call between President Trump and the Prime Minister. The Treasury Secretary Scott Bessent saying Japan is an important ally and praising the country for coming to the table quickly. So the EU gets pushed back and Japan gets encouraged.
Japan gets encouraged, and also I think the European Union is going to be looking at Japan. Japan's going to be the litmus test for all these allies with the United States on how to approach negotiations. I also think it's very interesting who is leading the negotiations with Tokyo. It is Secretary Bessent and Jamieson Greer. And Jamieson Greer will be on Capitol Hill today. I think it's really important to watch what he has to say.
He's getting a little bit more power over the last 24 hours, and I don't mean Greer. Greer's been in the mix for a while. Commerce Secretary Howard Lutnick seems to have stepped to the side here, and the Treasury Secretary Scott Bessent seems to be in the mix in a way that he wasn't just last week.
I completely agree. And I think the interview I had with him following the Liberation Day ceremony, he was projecting the fact that, look, I wasn't part of, it felt like he was saying I was not part of these rates. I don't know why Canada and Mexico are not on this list. But now he's the one that's going to be leading the negotiations for one of the U.S.'s most important allies.
So in the Oval Office yesterday, there was a get-together between the President and the Israeli Prime Minister, and we expected some questions about trade, and then we ended up with this headline: Iran and talks with the United States. Iran confirming those talks to take place this weekend over the country's nuclear program. President Trump saying the talks will be direct and are set to follow weeks of tension over discussions around curbing Iran's nuclear activities.
So President Trump was teasing this out last week. I asked him directly on Air Force One on Thursday. Iran is talking about wanting to have these negotiations, a diplomatic off-ramp with the United States, but they want to use an intermediary. And Trump said, I don't think that's true anymore. I believe that they want to sit directly with us. He says that I think it goes faster. You can understand the other side a lot better. And he doesn't think anymore they want to use intermediaries. And he confirmed it yesterday and said there's going to be a big meeting on Saturday. Iran's foreign minister, though, says those talks are indirect, though, Jonathan. So I think both camps are trying to save face and be able to say that they were either direct in terms of the United States or indirect in terms of Iran. I'm sure maybe we'll get a mixed match of the two.
This could have consequences for the commodity market. Oil prices are ticking higher this morning following the biggest three-day slump going back to 2021. Goldman saying that Brent oil could fall further below $40 a barrel in late 26 under extreme outcomes, including a global GDP slowdown and a full unwind of OPEC plus cuts. Daan Struyven of Goldman Sachs joins us now for more. Dan, good to see you as always, sir.
Thanks a lot for
having me. A couple of different things going on here, one on the demand side and another on the supply side. I think the demand side story is well understood at this point, at least. Could you share with us the developments on the supply side? What's driving these changes?
Yes, so we have taken down our base case for Brent crude oil prices to $62 per barrel by the end of this year, $55 per barrel by the end of next year, primarily on the back of the GDP downgrades that our economists have made over the last 2 weeks. We now expect global oil demand to grow by only 300 KBD this year, so barely any growth. On the supply side, we have also penciled in some modest increases in OPEC plus supply, with not only a bigger increase in May that they have announced, and we also still assume 2 small final monthly increments in June and July. So more OPEC supply, a lower GDP outlook has led us and the market to revise the outlook for oil prices lower, while a sharp reversal in tariff policy could lead oil prices to realize above our forecast. On that, the risks are still skewed to the downside because of recession risk and the possibility of greater increases in OPEC plus supply.
Last year, it was the year that logic died. Hasn't been resurrected, because I don't really understand why, if demand is falling off a cliff potentially and people are decreasing their expectations for growth, you're seeing OPEC increasing their supply, cutting prices at a time when prices are already going down. What's behind that move?
Yes, I think two main drivers of the OPEC decision to increase the size of the May production hike. First of all, I think it's a strategic decision to incentivize better compliance from other partners within the producer group, most notably Kazakhstan and Iraq, but also to discipline non-OPEC supply growth. And I think the market started to shift towards this equilibrium mid last year, when OPEC announced that production would gradually start to come back. The second reason is OPEC has been looking at spot data in the oil market, both demand and inventories, and they still look reasonably tight. However, markets are forward-looking and are very focused on the downside risk to GDP in the months and quarters ahead, even if the spot data are still solid, even if that's the case in commodities, but also at the U.S. economy. The hard data, for instance, initial jobless claims, are still spot, but markets are forward-looking.
Yeah, well, talking about forward-looking, there was this one analyst at Pantheon Macro that came out with this, that recent falls in oil prices and shipping costs will offset about a quarter of the impact of tariffs that will trickle through inflation positive. On the flip side, it will decrease capital investment to such degree in the United States because of the dominance of the oil industry in the U.S. What is the price point at which it really becomes deleterious for the entire U.S. oil industry?
Yeah, so at this point, we think that lower oil prices are still a net positive for U.S. GDP because the benefits to consumers from higher real income still outweigh the losses from capex in the energy sector. That said, we do think that the average break-even price in TI terms is around $50 per barrel. So if we move down lower, we're starting to sort of be in the center of the distribution of break-even costs, where a lot of producers will be under pressure. And actually, in 2015 and 2016, when oil prices dropped to around $30 per barrel, we wrote a piece saying low oil prices are too much of a good thing. And in fact, the sign of the correlation between GDP in the US and oil prices flipped. Low oil prices started to hurt activity on net in the US. This time maybe a little bit different. Yes, the shale sector is bigger, but they have become much less price sensitive. They're only reinvesting about 50% of their cash flows back into the business. In 2014, they were borrowing. They were reinvesting 130% of their operating cash flow back into the business.
Right. Post-COVID has really changed exactly where they're investing in that capital and using that capital. But what is the break-even price right now?
Average in the US, 50 TI, $55 Brent. But there's a whole distribution, and we're starting to hit price levels where it becomes relevant for more and more producers. And in fact, we now forecast US lower 48 crude supply to edge down. At the start of the year, we and the markets had a higher oil price forecast, and we were looking for increases. At this point, unless prices rebound, we think that U.S. lower 48 crude supply has peaked for the next couple of years. At least.
We were just talking about the fact that the United States is going to have these talks with Iran on Saturday. How do you weigh the geopolitical implications in the oil market? Because if a deal is struck, maybe we see more Iranian barrels on the market. But if a deal is not, it's going to be maximum pressure. Mm-hmm. And that Iranian oil going to China may be taken out.
Yeah. If you do see a deal, I wouldn't expect significant increases in Iranian volumes. We don't believe that sanctions have been a major constraint on Iranian oil export volumes. They have increased by about 1 million barrels per day over the last few years. If you saw a return to maximum pressure, you could see an actual drop in Iranian volumes. All other things equal, that would be positive for oil prices. But I think that OPEC has shown its willingness to very rapidly bring barrels back to the market if the spot fundamentals are tight. And so we don't think that you would see a major net tightening effect on oil prices because OPEC sits on a lot of spare capacity and is willing to bring those barrels back to the market.
Can we finish on gold?
Yeah, for sure.
Biggest two-day drop on the S&P going back to the pandemic. Gold fell. On Thursday, fell on Friday. What's the relationship between gold and risk assets at the moment?
So we think this is really a great entry point to go long gold. We think that spec positioning has been cleaned up because of all the margin calls following losses on equity portfolios. Forced selling. We do think that spec positioning has dropped from sort of the top 10% of history a week ago to probably now close to the historical average. So excellent entry point. We do think that in the base case, gold prices rise 10% by year end to 3,300 with the risk skewed to the upside. You could in an extreme scenario, rally to $4,250 per troy ounce by year end if markets become more focused on US policy tail risks.
So you think at some point the relationship between risk and gold reestablishes itself in a more traditional way? It becomes a haven asset?
I think if equity volatility were to moderate somewhat, I think the positive impact of heightened uncertainty on gold prices would be reinstored.
Dan, appreciate your time. It's good to see
Thanks
you.
a lot.
Thank you, sir. Dan Struyven there at Goldman Sachs. Finished on gold. Gold's still north of 3K. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Former JP Morgan strategist Marko Kolanovic says that President Trump is close to changing his trade policies due to market pressure. Kolanovic thinks that the Trump put would kick in if the S&P 500 hit around 4,800, saying that the president's body language shows that he believes he's lost the edge in his trade war. Elsewhere, Elon Musk's fortune fell below $300 billion for the first time since joining the Trump administration. Musk lost nearly $4.5 billion in yesterday's trade as Tesla shares extended their losses. Musk, though, to be clear, is still the world's richest person, despite losing nearly $135 billion so far this year. A check on Porsche shares, pairing some of their earlier losses, just down about 0.1% in the German trade. The car maker's China sales plunged 42% in the first quarter. That is the worst quarter in China since 2013. Deliveries in North America, the bright spot, however, rose 37% in the same period. The sustainability of those gains, though, have come into question with new tariffs and potentially rising import costs. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in the next hour. Up next on the program, rejecting a tariff pause.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals.
In just a moment, we'll catch up with the chair of the White House Council of Economic Advisors, Stephen Miran, from New York City. This is Bloomberg. Session highs on the S&P up by 2.3%, on the Nasdaq up by 2.2%, on the Russell we bounced back by close to 3%. Under surveillance this morning, rejecting a tariff pause.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs. They don't want to be in the hands of the Chinese. And the Chinese have turned out to be really not very good at that. People that are with us, they're with us. But we cannot be taken advantage of any longer.
So here's the latest this morning. President Trump keeping investors on edge. Additional tariffs set to kick in over the next 24 hours. Joining us now to discuss, I'm very pleased to say, the chair of the White House Council of Economic Advisors, Stephen Miran. Mr. Chairman, welcome to the program, sir. A warm welcome to Bloomberg Surveillance. I've got to ask you the number one question on the lips of a lot of people on Wall Street at the moment. Is this a negotiation or the new rules of the game? How would you frame things for people this morning?
Good morning, and thanks for having me. How I'd frame things is that it could be either. I think the president is famous for his negotiating skills. The president is renowned for pulling deals out of a hat when nobody thought it was even possible. I'd remind everyone that the Phase 1 China deal in 2019 was a fantastic deal for the United States that the president created. It covered intellectual property, it covered market access, it covered purchases of agricultural commodities, it covered currency manipulation, it covered all sorts of things, and it was a fantastic deal. And unfortunately, the Biden administration walked away from it and refused to enforce it, and that was a big loss for America. So the president is famous for being able to create deals when nobody thinks he can, and so that's what it can turn into if other countries come and offer the right things that persuade the president.
Well, let's talk about the right things. So as far as we know, Vietnam came to the table and offered to drop their tariffs to zero. That was rejected. The EU offered to drop tariffs on industrial goods. That's been rejected. What would be the right kind of offer? Are they aware of what the right kind of offer would be?
Right. So I think that a narrow focus on tariff rates is insufficient, because the truth is that the non-tariff barriers pose enormous barriers to trade balancing over the long run. countries have to open their markets to U.S. exports, and I don't know exactly what combination of details they have to make in an offer. But all I can say is that negotiating is better than not negotiating.
Stephen, the difficulty that people are having at the moment, and you're aware of this, I'm sure, is that they're unclear whether it's about barriers to entry or just the deficit, because they are two different things. Which one is it?
Of course, they're two different things, but they're deeply related and inextricably related. If you reduce your barriers to entry, you open your market to U.S. exports. Of course, the trade deficit will respond to that. I think that there's no question about that.
When you talked about yesterday, I know you gave a speech, you talked about this way of burden sharing and some other measures partners could take to potentially get to a deal. Things like even writing checks to the Treasury. How exactly would that work?
Well, I think there's a variety of ways that could work. For one thing, they could just, sort of simply say, hey, America is providing us with, with a defense umbrella, which creates prosperity, which creates peace, which allows us to prosper economically. They could say, hey, America is creating a global trading system backed by this defense umbrella, which again allows us to trade, which creates our prosperity, and we're going to help share the cost of those things. We're going to send some money to the United States to help it provide those things. I think that would be a fruitful outcome. But of course, it depends on what the president decides. The president will negotiate the deals that he thinks are best for America, best for Americans, and I can't get ahead of him on those issues.
You also talked about how partners can invest in and install factories in America, or trading partners. Could China do that?
I think they could, but it remains to be seen whether they'd be willing to. I think China's policy has been to try and sort of steal all the manufacturing market share for themselves, not only from the United States but for many of our trading partners as well. And it seems to me unlikely that China would be willing to make that concession up front. However, I would welcome it.
So China said yesterday they will withdraw. Trump said yesterday, that if China does not withdraw the retaliatory tariffs, the U.S. will impose an additional 50%, less than 24 hours, starting tomorrow. Do you expect those additional 50% tariffs to come into play?
I think that depends on the Chinese. And, my advice to them would be that they have a lot more to lose than America does, that America holds the leverage, and everybody knows that, and therefore they should seek a détente, and they should offer concessions which would persuade the president to relent.
Uncertainty might be a good negotiating tactic, but it's really bad for business. That's been the message from a lot of corporate executives, and what you're seeing certainly in markets. Are you worried that U.S. companies are going to stop investing, that could stymie some of the progress that you're hoping to engineer?
Yeah, so the president has been very clear that that what he's engaging in is a long-term improvement in the economic welfare of the United States and a long-term improvement in putting American workers on fairer ground vis-a-vis the rest of the world. Some temporary uncertainty will come along with the transition and with the imposition of those policies. That's without a question. However, I think it's important to understand that uncertainty doesn't really cause recessions. I don't think that there's been a recession that was caused by people wondering, what's going to happen tomorrow. Uncertainty can delay decisions. For sure, as you're saying, there could be some transfer of investment decisions, some transfer of hiring decisions from one month to another. That's absolutely possible. But there's limits to that, because eventually a firm is going to decide, hey, I really need to add this capacity, or hey, I really need to make a decision about what's going on. And at some point, waiting becomes not worth it. So is there a chance that the uncertainty causes sort of distortions in the month-to-month or quarter-to-quarter macroeconomic data that make one quarter look weaker and another quarter look stronger? Absolutely, that's likely, right? If it's not only possible, it's quite likely. But companies can't delay decisions forever. Eventually, they got to pull the trigger and they got to invest based on their evaluation of the most likely policy landscape in the future. And the president has been very clear about what that policy landscape looks like. In fairness, though, a lot of people, in particular Wall Street economists, have come out and said actually uncertainty can cause a recession. And we have heard that from a number of different Wall Street firms, from a number of different companies. And frankly, the Small Business Consumer Survey came out this morning and saw the steepest plunge that we've seen going back years. There is a question here about, yes, they have to ultimately make decisions, but when do they start laying people off? At what point are you worried about execution risk at a time where some of the structural changes take a lot longer than some of these policies are taking to implement? Yeah, well, look, there isn't really any material sign of layoffs in the macroeconomic data, so that's not something that I'm seeing right now at all. And what I would say is, again, to remind people that there are three legs to the stool. One is trade renegotiation. The other two are deregulation and tax reform. And those are still in the pipeline. We're waiting on Congress to extend the president's historic tax cuts from 2017, which will sort of preserve low marginal rates in American workers and firms. But on top of that, what we experienced in Liberation Day was a roughly 13 percentage point rise in the effective tariff rate on all imports, and that's going to create enormous amounts of revenue, hundreds of billions of dollars of revenue that can be used to provide additional tax relief for Americans. And the president has been pretty clear laying out certain forms of the tax relief, and I think that there's scope to go even further than that. I personally would like to. However, it depends on what Congress works out and negotiates with the president on that. I don't always get, I'm not the president, right? The president is the one who will decide in collaboration with Congress. But I think that using that revenue for additional tax relief would be a fantastic outcome. I think that deregulation is underway, and that the combination of making America more competitive via tariffs with making it easier to build and invest and hire here is a fantastic outcome. And when you look ahead to the future, there's going to be an America that's the best place in the world to do business, because the tariffs make it competitive, deregulation makes it easy, and tax reform makes it efficient. And tax reform keeps more money in people's pockets, makes it easier to hire, easier to invest, and those are all great things. And the markets will look forward to that. Markets should be forward-looking. Yeah.
You're talking about the entire policy proposal. Markets are forward-looking. They're already pricing in just that, the extension of TCJA. What more can be done on the tax side? Do you think we will get no tax on tip, no tax on Social Security?
Yeah, I think we'll see that. And I can't get ahead of Congress. I can't get ahead of the president. But the president's been clear in calling for those things, and I'm optimistic that we'll get them. And I'm also optimistic that we'll get some form of further tax relief beyond that. What form that takes, will be up to Congress and the president. But I think that it would be a fantastic outcome for American workers if we took money raised by tariffs levied from foreigners and used that to lower taxes on Americans. That would create a more efficient, dynamic, competitive economy that would transition into the president's new golden age.
Stephen, how can it be both? How can it be both a source of revenue to provide tax relief and an option for negotiations?
Well, tariffs raise revenue, and then
I've got
from
that
that
piece
revenue...
of it. Yeah, sure. But you said you can negotiate this.
Oh, because the negotiation. Okay, so I understand what you're saying. So presumably, if the negotiations lead to materially better trade terms for American firms, then you create a booming economy because there's much more demand for our exports.
And then we take the tax relief back.
Well, then you don't have this additional revenue to pay for that tax relief. But nevertheless, Congress and the president are determined to extend the original tax cuts and provide the additional relief that the president has spoken about.
Okay.
So it's a question of how much further beyond that can you go.
We'll keep struggling to make sense of it. We appreciate your help this morning. Stephen Miran there, the White House Council of Economic Advisors chair from New York City. The third hour of Bloomberg Surveillance up next.
There is not an external pressure catalyst on President Trump right now to pull these tariffs back.
Not only do they cause this uncertainty, but they also raise prices, that you see inflationary impacts from them.
The problem for the president is that a lot of world leaders are not quite sure that they can negotiate with him. They don't want to be embarrassed.
There's still a lot of moving parts to this.
The president's asking the American people for a long leash, and we'll see if the American people give it to him.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes out from the opening bell, and your equity market is at session highs, up by close to 2.8% on the S&P 500. On the Nasdaq 100, firmer by 2.6. On the Russell, outperformance up by 3.3. 1 minute after midnight tonight, additional tariffs, 20% on Europe, 24 on Japan, 34 on China, and maybe another 50 still to come. Is it avoidable? Are these the new rules of the game? Or can you negotiate this? The chair of the Council of Economic Advisors, Stephen Miran, with us just moments ago, saying it can be both. And that's what we're struggling to figure out.
People aren't really having a good time trying to make this logical and make sense. So there are two cases here. There's the bear case, which is that the tariffs, as proposed, go on at midnight tonight, and there is some sort of retaliation. The bull case is that everyone will come to their senses and realize that this is potentially really damaging, and there'll be some negotiating on some stance, whether it's the president or whether it's the Federal Reserve. It is hope that ultimately is the trade, and is what we saw briefly in markets, surge of markets by $2.5 trillion and then crash it again in the span of 15 minutes.
If you believe in negotiations, what can they offer? So Vietnam's offer to drop their tariffs to zero, rejected. The EU came out and made a smaller offer, said we'll drop all our tariffs on all our industrial goods, rejected. There seems to be more than just tariffs. More than just tariffs and maybe even larger barriers to entry. But then, even when you go through that, you're told that it's about the deficit. It's just about the deficit. Now, sure, one can inform the other. But at the moment, let's say Vietnam goes to zero. Let's say they drop everything. Let's say they don't manipulate their currency. You're not going to get rid of that deficit with Vietnam. That's not happening.
Well, I love the idea of if you go to a grocery store to get your food, you have a trade deficit with that grocery store. Do you say that you don't want to buy food from it anymore simply because you're going to grow your own food because that deficit is problematic? What deficit are we talking about? There is a fiscal deficit that the United States absolutely needs to deal with, and then there is a trade deficit that is a structural byproduct of the U.S. economy being the biggest in the world and the way that it is set up. If you want to undo that, what are you talking about? And that is the reason why a lot of strategists are trying to grapple with the unknown of what this new world order could look like and just what that could do to the footprint of American businesses.
3-day losing streak on the S&P. We snapped that this morning. We're higher by 2.6%. Coming up this hour, Meera Pandit at JP Morgan as markets whipsaw on tariff uncertainty. Patrick Moorhead of Moor Insights as Apple looks for a way around trade barriers. And Nancy Lazar of Piper Sandler on how the president's levies will impact the economy. We begin this hour with stocks higher following 3 days of losses on the S&P 500. Meera Pandit at JP Morgan writing, if tariffs stay in place, we're likely to see recession this year and severely impaired profit growth. Even if tariffs were paused or scrapped, uncertainty scars could run deep. Meera joins us now for more. Meera, good morning.
Good morning.
Let's pick up on that line. Even if they come off, the uncertainty in between, how much damage are we doing right now?
There are some things you can't unsay. And from a tariff perspective, to see how this has played out does create a challenge for businesses and consumers. Consumers can bounce back to some degree, but from a business standpoint, if you think about, well, things will get negotiated, maybe we'll come together with a deal. I want to wait until that deal is signed, sealed, delivered, until I start to think about hiring and CapEx. If I think the tariffs are going to stay on for longer, then I really have to reconsider how do I think about my structure and my costs and how I operate in this environment. So either way, people are a little bit hamstrung at this point, whether it's a negotiation or a longer term thing.
We're told that payrolls don't matter. Friday data, forget it, irrelevant. We're told the earnings this week, forget it, irrelevant. What are you putting your hands around to put together an estimate for earnings for the coming 12 months?
You've seen across the street a lot of people wiping out their earnings expectations, considering that perhaps tariffs stay on for the long run. It's so hard to think about where we ground ourselves because all of this is going to continue to engender volatility. When we think about potentially a pop in the markets today, we've seen pops during periods of heavy volatility. You see some of the best days and the worst days paired together because people are trying to make sense of things. And essentially, you have earnings season, which is probably going to look pretty good, especially with the lower dollar, but to your point, mean nothing going forward. We're going to have to hear about guidance and what companies are actually doing. That will help us ground ourselves to some extent. If we think about the economic data, it will broadly be dismissed for another month or so. So that also becomes a challenge. We gear ourselves back to the survey data. When it represented uncertainty, then it wasn't really telling us a whole lot. But now that it's representing, well, where do I go from here? The soonest measure we get of the economic strength, then we have to rely on that to some extent. And then it's rumors and headlines.
We were just speaking with the chairman of the Council of Economic Advisors, Struyven, Miran, who said that uncertainty cannot cause recessions alone. Is that true?
I don't think that's true, because if you're in wait and see mode, those are the three most dangerous words for the economy. Let's see how this plays out. We're not so sure. And again, that uncertainty and those scars run deep, even if some of these tariffs do come off. And that's the challenge here, because what comes off could easily come back on. it does seem like there is a potential that this is a negotiating position. If you think about the president's favorite word in the dictionary being tariff, he also wrote a book about making deals. So it's really hard for us to guess which way he's leaning here. But we did see deals during the 2018-2019 period. We did see concessions during the first month or so of his presidency. And there are some talks in the works. But what more powerful a negotiating position to be in than to say, I have nothing to lose? I think that's the phase we're in. Most market participants are not expecting tariffs to last longer than a couple of months. If that's not the case, though, there's more downside ahead.
It's a very difficult moment, especially because paralysis begets this question of what haven can you really invest in? And that was really highlighted yesterday when 30-year Treasury yields surged the most going back to 2020. At what point does that really raise concerns about the haven status of U.S. Treasuries?
Part of it, too, is the fact that there's this tug of war when we think about yields between slower growth, higher inflation. And I think yesterday's move was a reminder that inflation is still potentially a concern. I mean, if you do get deals across the board, but the Fed were to cut before that, then that puts them in a very tricky position and perhaps a reason why they may shy away from some of these emergency cuts that people have been talking about, because if all of a sudden a deal has been made, everything is undone, then they're still dealing with inflation at a stubborn base. So there is that fight between, do we see a recession versus do we see a deal and everything goes away? And we're starting to hear more conversations about debt and deficit, some of this reconciliation bill. And it does feel like the administration is tying itself in knots a little bit because tariffs are pretty regressive. They're looking to pay for tax cuts that are progressive, but then also talking about tax cuts and a higher tax bracket. So you're starting to see that the cohesion, as was pointed out in the last interview, thinking about negotiating versus revenue raising, the cohesion in the overall strategy is really hard for us as investors to think through.
I keep seeing everyone overly focused on the cycle and not enough focus on the system. The Struyven Miran piece that was out yesterday, the address to the Hudson Institute, I would encourage everyone to read. In it, he talks about the financial dominance of America coming at a cost. And he says, while it is true that demand for dollars has kept our borrowing rates low, it has also kept currency markets distorted. Are you thinking about how a structural shift in the system would take away a structural bid for dollar-denominated assets and what that might mean for the kind of multiple that we should put on equities, what it might mean for borrowing costs for the Treasury, those kind of changes?
It would be a total reordering, and I think we're still grappling with what those types of changes would be. But we have long said that when we think about different BRICS countries coming together or different other countries saying we're going to have a competing currency or we're going to have a competing system or digital assets, digital currencies, what we've always said is the biggest threat to the U.S. dollar is what we're doing domestically, how we're thinking about debt and deficits, how we're thinking about managing in the long run, because we don't want to get too complacent about that reserve currency status. Now, look, the dollar underpins most financial transactions, cross-border payments. It is so entrenched in the system that we are in. So it would take a very long time to erode the power of the dollar. But nonetheless, you can start to see some of this on the margins. And I think a big example of that is the fact that we're seeing a lower dollar at a time where there is fear around a U.S. recession, which is unusual.
You know, I want to build on what John was talking about because it is interesting when you read the actual economics underpinnings of some of what's going on and some of what's being posited. It actually does go completely against the trend that we have seen in markets for the past some 50 years. I'm just wondering, even if it doesn't all come to fruition, even if you can't take it completely literally on its face, doesn't it make you want to go elsewhere anyway, just because the source of volatility is the United States right now?
There are some things you can't unsay, and that is really, again, the big challenge with all of this, no matter what happens. And we are seeing that. It was supposed to be the year where growth continued to outperform value, U.S. continued to outperform international, duration underperformed, and yet we've seen a flip of most of that. And we've seen within international markets that they're outperforming the U.S. by almost double digits and had been positive up until very recently, because even though they're going to take on a lot of these tariffs, they're also acting in a forward-thinking way of how do we reduce some of this reliance on the U.S. when we think about defense spending, innovation, technology, just a greater attitude of self-reliance. And you're also seeing that, look, some people are saying we're going to play ball a little bit. When we think about international investing, some of the areas that could look a little bit more interesting than others, areas like India, where the negotiations are at play, areas like Latin America, where you're not seeing as much of an impact from higher tariff rates yet. And maybe there's a little bit more of a gearing towards China. So we do continue to look at some of the relative advantages across the market here. Again, value versus growth outperforming by 10 percentage points year to date. But certainly overall, it's a really tough market. We don't want to get too cute. We do want to rely on the sensible diversification that we've maintained, because a lot of those unloved areas are actually what are protecting portfolios right now.
Meera, it's good to see you. Thanks for dropping by. Meera Pandit there of JP Morgan Asset Management. Equities session highs by close to 3% on the S&P 500. The dance continues. Is it a set of negotiations, or are these the new rules of the game? And the pendulum keeps swinging between one and the other. Over the weekend, it was these are the rules of the game. And then Monday, it became these are negotiations. And that continues this Tuesday morning.
And frankly, you asked that to Struyven Miran. And he said,
both.
It could be both. It could be either. It's the president. And so we're not getting a clear answer by design. It seems as though this is a feature, not a bug, when it comes to the differing opinions and sort of a cat's in the bag approach, where you've got a lot of animosity or discussion among different people in the council. It just makes it very difficult for investors and very difficult for companies.
As the pendulum swings, that does damage to the economy. Still working out if it's one or the other. That uncertainty starts to hurt. That uncertainty comes up in the sentiment surveys. Meera was talking about that. The reality of where the policy is now comes up in the sentiment surveys, and that shapes action in the months and quarters to come.
And we have to also add to that, we already have seen the 10% baseline tariff implemented. And tonight at midnight, it isn't just uncertainty. There will be certainty of tariffs that go into effect pretty much across the board that would set the tariff rate of the United States at a level that it has not seen since the early 1900s. So there is uncertainty, but there also is action, and people are responding to that.
Equities are up this morning. Session highs up by 2.9% on the S&P. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump is set to sign an executive order expanding mining and the use of coal in America. The aim is to power data centers and revive the declining U.S. fossil fuel industry. The order directs the federal government to take steps to reinvigorate coal and accelerate the export of U.S. coal and related tech. ECB Governing Council member Emanuel says that the central bank should cut rates at next week's meeting due to the impacts of President Trump's tariffs. French banking giant SocGen also called for a 50 basis point cut next week and extra cuts to follow in June and July. Harvard plans to borrow $750 million from Wall Street as federal funds come under threat from the Trump administration. Proceeds will be used for general corporate purposes. Bond documents show Goldman Sachs as the sole book runner on the transaction. The administration has already frozen funding for Columbia and Princeton University. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Up next on the programme, the Morning Calls Plus, Patrick Moorhead of Moor Insights as Apple looks for a way around trade barriers. That conversation just around the corner. Equities at session highs. You're opening about 1 hour and 16 minutes away. The S&P up by 2.8%. The opening about 1 hour and 14 minutes away. Equities higher. Near session highs up 2.6% on the S&P. On the Nasdaq 100 up by 2.5. On a Russell up by 3. That's the price action. Let's get you some morning calls. First up, JP Morgan upgrading Levi Strauss to overweight, noting stronger pricing power that should offset tariff headwinds. That stock is bouncing this morning by close to 13%. Your second call from Goldman, upgrading Eli Lilly to buy, citing a compelling entry point and predicting the company can maintain its pole position as sector leader. The stock is up by 3%. And your third and final call from Morgan Stanley, downgrading HP Enterprise to equal weight, saying thinner margin structure provides less buffer against tariff impacts. That stock just about positive this morning by 0.9%. Let's stick with tech. The Wall Street Journal reporting Apple is planning to source more iPhones from India to the US to offset the cost of China tariffs, a short-term stopgap as the tech giant looks to win a tariff exemption from the White House. Joining us now is Patrick Moorhead of Moor Insights. Patrick, welcome back to the programme, sir. Are you operating with the assumption that they can get that exemption?
I am currently not working under that, and I look back at history where Apple has been exempt a few different times. China made some commitments on trade balances back on Trump 1.0. I just don't see it happening at this point, because if Apple gets a reprieve, why not HP? Why not Dell for PCs? Why not Samsung for smartphones, where they have invested hundreds of billions of dollars just in semiconductors here?
Patrick, this goes in several phases, and to your point, the list would go on and on. The names would keep coming. For Apple, the first phase seems to be people rush into the store and get iPhones at a price they're at now. What's the next phase after that? What do things look like for the company?
Well, it's really a long road ahead. China alone had to import workers from Malaysia. There have been reports that I think if you back into the numbers, that it requires over 1 million workers in China to be able to put together iPhones and iPads. And you can't just replicate that overnight in any country, including India. Let's say 10% max can be moved over within 12 months. You're still staring down the barrel at up to 104% tariffs in China. Again, it changes day to day. But at least a 52% plus a tariff. And even in India, right, you have up to a 37% tariff. Now, I do believe that if deals were made, India would be at the front of the line. But unfortunately, we haven't seen any discussion on India, right? We've heard about Japan. We've heard about Israel. We've heard about Vietnam, but nothing about India. So what's better, 104% or 37%? It's 37%, but Apple cannot move quickly enough. It could take 5 years if they wanted to move most of their manufacturing anywhere else in the world.
Patrick, Apple has lost about $640 billion of market capitalization since end of day on April 2nd. That is about 19% of its value. How much more downside do you see ahead if you don't get some sort of carve out from the tariffs that have been announced?
I mean, I don't want to be too dramatic here, but if you're more than doubling the price of an iPhone in a worst case scenario, the stock value could be cut in half. People don't believe that. Otherwise, they would be trading on that, and they're looking for some type of reprieve. But you have to factor in that possibility that China is the number one negotiating point for the entire administration. And I have a thesis that says it's really only about China, right? It's building a blockade of partners who can take on China, and they will be the last one to negotiate out there. The other part, which I've heard a couple of your guests talk about, is this fear of recession. So Apple gets hit with the double whammy. They get hit with the Chinese manufacturing hit up to 104%, and then they get hit with a potential recession risk. And if you want to put a trifecta in there of increased prices, it is a very gloomy short-term view on Apple that investors so far aren't incorporating.
Patrick, is Apple uniquely positioned in a poor spot, given the fact that they are kind of hamstrung with production and, frankly, also selling into China at the same time that they are a consumer-facing tech company with the iPhone? Are they uniquely in a bad position relative to the other large tech companies?
They're very unique, and we've segmented our list into most at risk, potentially at risk, and least at risk. And they are at the most at-risk company related to China for the very reasons that we've outlined on the show today, with the adder that you just laid out there, that the Chinese consumers have a voracious appetite for Apple products, and they get hit on the reflexive tariffs from China, and they get hit on the tariffs coming into the United States. So somewhat free trade for Apple is limited to Latin America and Europe at this point.
Patrick, I'm pleased that you separated tariffs and the cyclical downturn that we might expect, and the two headwinds for certain companies. Something I think about from time to time, and I'd love your input on, is whether these companies in their current form have ever really been tested by a cyclical downturn here in the United States. And I don't think the pandemic counts because we had so much stimulus flushed into the system. How do these companies respond to a cyclical downturn? Because for years, people said, keep buying, it's a secular growth theme. Keep buying, it's a secular growth theme. How do these companies stand up to a cyclical downturn here in America?
Yeah, I'm glad you separated out the pandemic because it was a very different type of scenario, but we haven't seen a full-on recession since 2008 here in the United States. And I would expect the same gameplay to happen where we would have massive layoffs, prices would go down, interest rates would go down to stimulate the economy. I think we would see probably at least a point reduction once we're knee-deep in a recession to stimulate it. But the challenge here, though, is, again, we're trying to figure out what the administration actually wants. Do they want a systemic change or do they just want a better deal? You can't build a complex factory in the United States for 1, maybe 2 years at best, and then you've run out of people to actually run those factories. We're already at very low levels of unemployment, and workers just in the United States just don't want to do this type of activity. You would see likely a lot of hugging and kissing between the United States and Mexico, right? Mexico is the next best alternative to these very highly tariffed countries to be able to lower the overall cost. If you look at the wages between Mexico and, let's say, Southeast China, they're still twice as much, but you're still looking at around $5 per hour. So that's the way I expect this to play out. A lot of doom and gloom, a lot of layoffs, and probably a down economic environment that we haven't seen in 25 years.
We hope to avoid it, but that's your base case at the moment. Patrick, thank you, sir. Patrick Moorhead of More Insights. Appreciate your time. It takes a long time to engineer that supply-side response. Higher prices are a key feature of engineering that supply-side response. In the meantime, though, who's going to build that factory right now when you are muddling the message around Washington, D.C., saying this might be a negotiation, these might be new rules of the game? I think a lot of people might wait.
How many times have we heard this from Mike Wirth of Chevron? The long time that it takes to make investments and that predictability of policy is the most important thing that they need for that long-term type of plan.
It certainly goes beyond the term of this presidency as well, when the rules could change again. And this is another issue for everyone. On the S&P 500, up by 2.5%. Up next on the program, Nancy Lazar of Piper Sandler, Marta Norton of Empower. From New York, this is Bloomberg. The Up and About 60 minutes out. Equities near session highs, up 2.6% on the S&P 500. On the Nasdaq, up by 2.5%. Also on the Russell, the small caps up by 3. 1 hour away from that cash open with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Kicking it off with the biggest mover to the upside for the S&P 500 pre-market. That is Humana, the health insurance giant, up 16.2%. This comes from a decision after the close yesterday from the Trump administration to significantly increase the Medicare payouts for private insurers. $25 billion. That exceeds even the most optimistic of estimates. So Humana, CVS, United Health, all those are higher in the pre-market. Broadcom also higher. That is up 5.75% this morning. A $10 billion buyback that they are putting into this market. Remarkable for a company that is highly exposed to international supply chains in the midst of tariffs. Even so, they are doing this vote of confidence after their stock slid some 30% year to date, so a whole lot cheaper to buy things back. Levi's also reporting earnings. This is an interesting one because it's really the first retailer to do so in the face of tariffs. And people have been looking, what will they say about tariffs? What does the C-suite say? Well, you can see by the reaction, they had not too negative comments, 13% rise pre-market. They maintained their outlook for 2025, but here's the rub. They said that assumes that there's no deterioration in the macro environment, in consumers, in supply chains. They admitted that they're having a hard time analyzing just the impact of tariffs, and they have now assembled a task force to try to understand that. John.
Danny, do you think in the boardroom when they came up with this idea, do you think they realised how affected it might be, looking at that gain in that stock?
Well, look, it worked because I think the assumption was that they would come out and say things are looking really dire for us, but they didn't do that. In fact, John, they said that this quarter tariffs have a minimal impact. It's gotten people excited, but what happens when they actually need to incorporate the outlook?
Danny, thank you. Their stock is up by 13%. Bramo seen. Everyone looks at that and they're like, playbook, let's go. So they come out on the calls over the next several weeks and months and say, we assume no change to the macro outlook off the back of the policy changes down in Washington.
You have to wonder how much collectively Wall Street looks at that and says, whew, that sounds great, cool. Or how much people say, what are we talking about here? I can imagine, based on the rhetoric that we've heard from a number of executives, whether it's JP Morgan's Jamie Dimon, Ken Griffin of Citadel, or frankly, Larry Fink of BlackRock, telling Eric Schatzker of Bloomberg at the Economic Club yesterday that most CEOs he speaks to believe that we are in a recession currently. How do you square that?
Equities right now, session highs. That's how we're squaring it at the moment. Busy week ahead. More tariffs set to take effect overnight. Fed minutes as well, just around the corner. And some eco data through the week. Mike McKee has it all. Good morning, Mike.
Good morning, John. Well, the problem with this week's data and the Fed minutes is they're very backward looking, and the whole situation has changed to start looking forward. We're not going to get a lot of information for the Fed to make decisions on this week. Even if we get some movement in the CPI or PPI, we might get some initial tariff reaction in that. I would point you to Friday's Michigan sentiment report instead. See how Americans are reacting to the latest news. It will have data through Liberation Day, and it will have the tariff impact on inflation expectations. So Friday, look for the University of Michigan. Then next week we go to on Wednesday, we get retail sales. That'll be important to see if people have started to cut back, whether or not there are tariffs, and that could influence the Fed. The Fed's going to have to wait and see at this point whether inflation or growth take precedence under tariffs or whether we even have tariffs. So I wouldn't expect a whole lot out of this week to move a lot of Fed thinking.
The same debate just continues. Mike McKee, thank you. Fed officials, to Mike's point, going around worried about upside risk to inflation, potentially downside risk to growth. Nancy Lazar of Piper Sandler seeing tariff-related inflation as a one-off and saying, quote, easing aggressively now would risk a sharp inflation reacceleration in 26. As of now, after the one-off tariff inflation hit to the economy in 25, inflation is likely to slow in 26. Nancy joins us now for more. Nancy, good morning.
Good morning.
Are you suggesting they just wait then?
I would prefer the Fed be more ease very, very slowly, because, again, what you don't want to do is repeat what we did in 2021, which was eased in a temporary shock. And then create way too much liquidity, and inflation indeed comes back. I didn't like the fact he used the word transitory again.
Not many people did.
Nervous. Yeah.
JP Morgan Asset Management, Bob Michael, on the programme with us on Sunday evening as we waited for equity futures to open on the S&P 500. He said maybe this Fed couldn't wait until the next meeting. The next meeting's the first week of May. Can they wait that long?
Oh, I would say, again, this is not an interest rate problem. In fact, the lagged effects of a Fed easing cycle are still going to help the economy once uncertainty can come down and these price shocks can fade. So the Fed has already eased. Let's not forget that. And as we move into the back half of the year, they could actually already help to support growth. So, yes, later rather than sooner would be healthier for the long-run inflation outlook.
What's the historic analog to now where we can get some sense of how inflation has behaved with tariffs at a time where potentially you could also see some sort of demand shock?
So you can go back to 2018, where you had two industries in particular that had big tariffs on them, both washing machines and furniture. And you saw an increase in price immediately. And then you had a decline in unit sales immediately. And then over the next year, you started to see prices actually decline because of that weakness and also the substitution effect. So again, it would be best for the Fed to be patient as we go through this price shock. See a dip in the economy, maybe 1% GDP growth as we move into the second and into the third quarter. And then by the back half fourth quarter into 2026, you can see an incremental improvement in the economy. And the Fed doesn't have to do much to get that.
Some people would argue, including the likes of big Wall Street firms, and a number of Wall Street firms have predicted a base case now of recession, including JP Morgan. Why should the Fed look through that, given what the surveys are showing and given the fact that companies may come out and give some guidance other than Levi's, but may give some guidance to that effect?
Well, they may not look through it. They may incrementally ease. But again, the Fed has already eased. Our models were actually pretty optimistic for 2025, seeing a healing in the economy as we move through the year because of the easing cycle that we saw last year, lower bond yields that we have started to see. Now, oil prices are down. There are basic supports for the economy. This is a one-time price shock. And to ease too aggressively, again, risks creating this inflation next year.
Let's talk about those risks of it not being a one-time price shock. Yep. What are the sources of inflation that would concern you going forward from here?
Well, wage inflation actually has been very sticky over the past year. Even average hourly earnings have basically stopped slowing, even prior to the current environment, which told us that inflation was again sticky in 2024. And I think the Fed should heed that. And you've also seen it in some of the price measures, again, here in the first part of the year, where you've seen the ISM price measures increase pretty much across the board within the regional Fed measures.
Neil Duss has made a similar point from Renmark about the risk of second-round effects. He talks about the anxiety of the consumers right now, and you see it in the reports and the surveys. They're anxious about higher unemployment in the future, and if that's the case, the idea that they're going to go around and bid up their wages anytime soon is difficult to get your head around.
Which is a reason why a lot of people aren't looking to that kind of inflation. Are you arguing that potentially a Fed rate cut of even 50 basis points could engineer that confidence at a time where this shock isn't coming from elsewhere?
No, I don't think a Fed rate cut. I think the next major issue for the markets are going to be, one, what inflation does in say, April and May. You're going to get a price shock, a big price increase from the tariffs that are being put in place. We think CPI could accelerate to around a 5% quarter-to-quarter annualized run rate, and that's going to take consumer spending down, and we're watching our daily consumer confidence survey. So no, we think the Fed can ease. They just can't ease aggressively. And they've already been in an easing cycle. They've pulled back on QT, and so let's not get carried away, because there are longer-term supports for the economy as we come out of this, and which we hopefully is by the fourth quarter of this year.
A couple of weeks ago, people were talking about the sequencing of the policies coming out of this administration, that the difficult stuff came first, the tariffs, some of the negative growth shocks, and then the pro-growth shocks come later on with respect to tax cuts and deregulation and other aspects. How much are people overlooking that as a potential catalyst for some growth and, frankly, potentially even inflation, and discounting how much of an upward stimulus that could be on the economy?
Oh, I think that is a very, very significant point. I started in the summer of 1981, and it was chaos in the summer of 1981. Volcker wasn't sure if he was going to be successful. Reagan did similarly. He was going to take some pain near term, allowing Volcker to do what he wanted to do. He fired people. I'm not comparing Reagan to Trump, but I'm just suggesting it's not unusual for an administration to do that. And the longer-term positives are positives. To have onshoring, which I've been focused on for 15 years, is an incredible positive. There are people who want to work in factories. Clarity on the tax reform, deregulation, a smaller government. So there are some longer-term positives if we can potentially negotiate some with these tariffs. I'm also for free trade. I'm also for fair trade. And if we come out of this current turmoil with some fair trade, then yes, you can add that to the list of positives for 2020, 2025.
Nancy, I share that sentiment almost entirely. I'm pleased you said it. I think this has been a problem for a long, long time. It goes back decades. I think this administration, led by this president, has done a tremendous job of articulating that problem. The president's done it going all the way back to the 1980s. This is about whether this is the right policy executed in the right way to try and remedy this situation, Lisa. And I think they're two separate conversations. I think you've got to be able to acknowledge the former and then have a debate about the latter. And that's the struggle that a lot of people are seeming to have at the moment over the past week or so.
I'm so glad that you framed it that way, because I think a lot of people do agree that there's some issues, some problems that are very correctly identified by the administration. it's execution risk. Yeah. It's this question of the uncertainty itself that does have a prolonged period of time, and how it is a key feature in the way that maybe these deals might be being negotiated or not, or maybe this is just simply policy, John.
Nancy, it's good to see you.
You too.
Thanks for dropping by. Thank you. Nancy Lazar there of Piper Sandler. Equities at the moment on the S&P 500 higher by 2.4%, all trying to work out this three-way game of chicken. Nouri Arabini said it's she, it's Powell, it's Trump. This is what Marta Norton of Empower's got to say. The Trump put may prove the only game in town when it comes to pulling the market out of its current spiral, but whether that exists is in question. Marta joins us now for more. Marta, welcome to the programme. Let's talk about that Trump put. Does it exist?
You know, I think that's what we're all wrestling with. And I think the reality is that it's very hard to put a probability on whether the Trump put actually exists. It's hard to know whether we're going to see serious negotiations around these tariffs. Our concern heading into Liberation Day was that the market wasn't really pricing in the worst case around what tariffs could be. And as we look forward, now there's a bit more pricing in of the range of outcomes, but still that worst case remains elusive, especially if the Trump put remains elusive.
And Marta, as you know, we're swinging from is it a negotiation to are these the rules of the game from day to day. I'm interested from your perspective, how much damage we do in between as we try and figure this out over the coming weeks and months?
Well, I think in the very near term, a lot of the damage is happening and not necessarily likely to get more destructive, in the sense that we're already in a very heightened, uncertain period. Of course, if we see these retaliatory tariffs from China and the U.S. back to China, of course, that raises the stakes a bit. But I think the question is more on the longer term outlook for where earnings land here. I think the markets can sustain a period of volatility, but if we see this tariff fight drag on into the next quarter, I think we're looking at an environment where we can see a lot of the earnings growth that people expected for 2025 come out altogether.
When you take a step back, there's a question right now about reordering the structure of global trade. These are pretty lofty goals at a time when people have counted on a classic 60-40 portfolio for a long time, where bonds were the ballast and stocks were the growth aspect. Do people have to rethink their longer-term allocations, given that there are some pretty massive changes that may be underway?
You know, it's a really important question. And what I come back to in this environment, this is very different than 2022. When we were in 2022, we could say diversification was of no value whatsoever, especially from the stock bond perspective. But as we sit today, I know we're not getting the kind of oomph out of long-term bonds that we'd like to see, but we are seeing bonds hold up in a way that they didn't in 2022. We're also getting that value from a sector diversification, consumer staples behaving, for example, very differently than what we're seeing from technology, and we're getting diversification geographically as well, you know, in terms of how we're seeing other markets respond to this environment. So I think we can argue in some ways that the 60-40 or the diversified approach is being reinforced in a way in today's environment that it hasn't been in recent years.
Yesterday, someone made the argument that actually indexes are going to have less import right now than they have over the past decade or so, simply because specific companies are going to handle each of the potential regime changes differently. Apple is a perfect example, how they're in the crosshairs versus, say, a Microsoft that might be not as exposed. How do you counter that, the idea that the indexing era might be really entering a new territory?
Well, that's a very powerful point, and I would argue that the idiosyncratic, conversation that you're raising in terms of how these different companies behave in this tariff era is something to watch. I would also argue that it's the market cap weighted effect that set us up for the kind of destructive price action that we've seen so far in 2025, excuse me. The technology, accounting for a third of the S&P 500, the Mag 7 accounting for a third of the S&P 500. People were concentrated in a way that they didn't really even plan to be on an active basis just by passively tracking the market. And so I think we're seeing the risk of that unfold in today's environment. And I think that's one of the reasons that you would call for maybe looking to some of these other ways to index the market. Equal weighted is an extreme response to that, but there are different ways that you can add index-like exposure without having that market cap weighted exposure dominating your portfolios.
Marta, appreciate your take. Thanks for joining us. Marta Norton there of Empower. This could change how people invest. This is the system change that we're trying to get our teeth into over the past week. As we focus for good reason on what might happen to the cycle, there's going to be something much bigger than that in a decade to come, potentially off the back of these changes.
I love the point that you made, raising Stephen Miran's point that he raised yesterday, that essentially they're looking to restructure things, that the strength of the dollar was actually a bug, not necessarily a feature of the trade deficit and some of the structural issues. That might change. And if that changes, how does that shift the way people think about asset allocation? Also, we have a whole lot more debt. And how do we have to think about how our response is if there is some sort of recession in the near term? Look, my head's spinning, which is you can hear. And it's hard to kind of wrap your head around. So sometimes it's good just to say, well, maybe things will just stay the same.
America has had the privilege of behaving recklessly with its debt for a long, long time. I wouldn't take that privilege for granted. Yes, it comes with a structural bid for the US dollar, which is something that Stephen Miran has complained about. I understand that. But that's a delicate balance between those two things. You try and address one, you might upset the other. And I'm not sure that's something you want to do as you look to extend tax cuts in the not too distant future.
If you are the major trade partner of the world, then people need dollars to transact trade. That means that they want to invest in dollars to offset anything that happens to them. If there isn't that incentive, how do you have the privilege to act recklessly in the same kind of way with a deficit that's the highest level per GDP in history?
It's a delicate balance, that's for sure. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Billionaire Ken Griffin says President Trump's latest tariffs are a huge policy mistake and a tax on families that will increase costs for everyday items. Griffin, who is a Republican megadonor, urged people to reach out to Trump to get him to reconsider his tariff policy. Elsewhere, New York City's congestion pricing program is likely to remain in place for the next several months. The MTA and the Trump administration have agreed to a timeline that would keep congestion pricing tolls on through late October as both parties await a ruling, that all according to a court document. And in sports, the Florida Gators are the 2025 NCAA men's tournament champions after beating Houston in a thrilling championship game. The Gators came back from a 12-point second-half deficit, taking the lead in the game's final minute after trailing for most of the game. It is Florida's third ever title and its first since 2007. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead from New York City. You're watching Bloomberg TV. The open about 39 minutes away. Equity futures up by more than 2% on the S&P. On the Nasdaq up by 2.1. On the Russell up by 2.5. Your calendar for the next few days looks like this. At 3 p.m., the president signing executive orders around U.S. energy production. At midnight, reciprocal tariffs kicking in. On Wednesday, Delta earnings just around the corner. Thursday, CPI plus another round of jobless claims. Friday, PPI and UMich sentiment plus bank earnings kicking off with JP Morgan, Wells Fargo and Morgan Stanley. Let's head down to Washington, D.C. and catch up with Tyler Kendall from the nation's capital. Tyler, welcome back to the programme. There has been, and I know this phrase gets derided, but a shift in tone, is it fair to say, in the past 24 hours?
Well, John, I think that is fair to say, in fact, that we are seeing this White House be a little bit more open when it does come to the negotiations, although it appears that there are still some big hurdles to cross and that we're not going to see any deals ahead of tomorrow. I'll also say that we're perhaps seeing a shift in tone from some on Wall Street. Fresh reaction from Bill Ackman, who said that he thinks that some might have misconstrued his recent comments on tariffs, writing today that he supports President Trump using tariffs to eliminate unfair trading practices, and rather that he's actually advocating for a 30, 60, or 90-day pause to complete negotiations. Again, as you well know, President Trump saying yesterday that he's not considering such a pause as they try to strike some deals moving forward.
Tyler Kendall, thank you. Appreciate it. You know who's striking gold? Mike Platt at Bluecrest, gaining 20% on the tariff volatility. I always say this about Mike Platt at Bluecrest. My goodness, the ability of that firm to trade through different regimes, different moments, just repeatedly over the course of a decade is just nothing short of phenomenal. Just absolutely amazing.
I would agree. I want to hear the secret sauce. I want to understand how they played this the right way, given the volatility that we've seen on an intraday, an intra-hour, intra-minute point of view based on headlines. This is a tough time, and not losing money has been the benchmark. To gain 20% is pretty impressive.
I've been trying to get Mike to come on the programme for years. I'll keep trying. I'll keep pushing, because this kind of performance is just absolutely amazing. Let's talk about where we are right now. OK, so it's the difference between negotiating versus are these the rules of the game? People believe that the pendulum has shifted back towards, say, negotiating. So let's talk about negotiating. What can you negotiate right now? What is it that this administration would like to see? Because Vietnam made an offer, rejected. The EU made an offer, rejected. And now they're saying that tariffs and tariffs alone are insufficient, that this needs to be much bigger, much broader than just that.
Which goes to the question that you were asking, is this eliminating the trade deficit? Or is this something else? Are these just eliminating, say, for Europe, the VAT tax and this question around non-tariff taxes or barriers to entry that might be different and non-comparative in the same kind of way? This week, I think the most important point will actually be Delta earnings. More than the banks, more than any of the economic data, which everyone will just simply ignore. But if Delta comes out and says people are canceling their vacations and businesses aren't spending, that indicates that actually this uncertainty and this paralysis is going to shift into something that starts to take hold. We hope it doesn't. Levi's, if they are the example...
I'll just come out and say nothing's going to change.
If they come out...
Levi's.
Okay, if they come out and they say nothing's going to change and we haven't seen a shift in demand and we've actually seen it revive since February, imagine how big that rally will be right now in markets.
Just got a great message. I always say this too, that we have the smartest audience on the planet, the most dialed in, most sophisticated. And I just got a message from a viewer about what they're calling the mismatch of maturities, the maturity mismatch between addressing trade versus execution. So policy has this set deadline, which is days, literally overnight tariff implementation. And then you've got the dynamic that takes years to take effect, which is onshoring of manufacturing. The mismatch between the two is the difference between the pain you need to take now for maybe the success down the road, and the destination is still not secure either.
It's a wonderful way of framing it to highlight how a lot of people do think that there are some changes that need to occur with trade and changes that need to occur with supply chains and manufacturing. The time that it takes, though, to do that is much longer than a lot of these companies are dealing with when it comes to facing off with some of these tariffs. Again, execution risk. That is what a lot of people are trying to understand.
We keep going back to the same question, and you said to me yesterday we'll be asking that question for weeks, and I imagine tomorrow morning we'll be asking the same question. Are these the rules of the game, or can you negotiate them? Andrew Sheets of Morgan Stanley will help us answer that question alongside Chris Harvey of Wells Fargo, Richard Bernstein of Bernstein Advisors, and Ryan Peterson of Flexport. That conversation timely.
How much are people just leaving ships in the middle of the ocean with goods on them, not wanting to bring them in because they're not sure what they're going to have to pay for them and whether they can pass those costs along to the consumer?
Equity futures session highs were higher by 2.4% on the S&P 500. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.